Fed has to do its job, get inflation down.
The Fed is hiking interest rates into a known slowdown in the markets. This is something that they don't normally do.
We have heard from a lot of companies that they're thinking the following environment is going to be more challenging.
High inflation and policy tightening raises the prospect of a pretty significant slowdown.
We're seeing signs that global economic growth is decelerating at a pretty rapid clip here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Breaking news, Bramo is back. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures up 0.5%. TK, big week ahead.
Big week ahead. The Fed meeting there. We're getting ready for a show. We have a terrific lineup of guests to give you perspective on the Fed show, but we got to get there first. And to me, it's the recession debate over the weekend. I thought a really rich weekend of research. Ben Laidler, he's been so good on staying in the market. He says recession is not inevitable.
Tom, it's the distance to September 21st. It's the meeting after this meeting.
I totally agree.
If this is 75, is it the final 75 basis point hike from this Fed?
Long ago and far away, and of course, there's an election coming on. It's a mid-year term. I'm going to go FOMC go. You know how to do that, John, on the terminal. We got to get Lisa reacquainted with the terminal. November 2nd after September 21, ever more important, too.
It's been a while, hasn't it, since we said good morning, Lisa? Let's say good morning, Lisa, right now. Good morning, Lisa.
I hear that I was, hiking on Mount Everest
base
and
camp.
checking my oxygen level?
We wanted to keep it realistic.
I love it.
We did.
Thanks. I appreciate that. It's good to be back. And it sounds like as I was gone, it was more optimistic.
Did you get a headache?
Right?
Did you get a headache coming back on Cutter through,
I thought you were going to ask whether I got a headache coming back on the show. I will say it does seem to be a little bit more pessimistic out there than it was last week. And I wonder how much this has to do with dollar weakness that has been a sort of ongoing theme in the wake of the ECB and how much that's given a lift to a lot of the risk assets that when I was around weren't doing so hot.
Let's complete the A block, then we'll give you a migraine. Futures this morning, good morning. Up 0.5% on the S&P 500. On the NASDAQ 100, up 0.5% also. Yields look like this, up 5 basis points at 279.95. We need to talk about the data. Pretty terrible on both sides of the Atlantic. The PMIs last week. This morning, German business confidence, pretty brutal too. Euro dollar 102.40. Lisa, the euro showing just a little bit of strength this morning.
To me, that was the big story of last week. And I understand that I was probably hiking in Mount Everest or wherever I was. That, however, I was tracking. And it seemed like that seemed to be the big shift. Euro strength suddenly after so much weakness. Today, not a huge day, but this week, John, as you said, a monumental week for the United States. Last week was all Europe. This week, all the U.S. We've got big tech earnings throughout the week. On Tuesday, we've got Microsoft and Alphabet, Google, Tom. I know you're not going to like Alphabet. And then on Wednesday, we get Meta, Facebook, as well as a slew of some of the software and hardware providers. And then later on in the week, we get Apple and Amazon on Thursday. On Wednesday, the FOMC rate decision and press conference, the key issue people are talking about. As you pointed out, both of you, it's not the 75 basis point rate hike that everyone's expecting. It's what happens in September and how does this Fed calibrate the dual mandate of both getting down inflation and dealing with an unemployment rate that has to rise if they want to get that inflation rate down. And that seems to be the tension that a lot of people are looking for some guidance on. And this week we get a slew of economic data, including on Thursday. This is what I'm really interested in. The U.S. second quarter GDP figure. Does it come in negative? Are we already in a technical recession because we did have a negative GDP print for the first quarter? How much does that shape the view, especially because it comes the day after the Federal Reserve? And then on Friday, we get the ECI, that employment cost index. And John, you remember how in the last couple of meetings, that's been a key indicator for this Federal Reserve. Are we starting to see the cost of employment go down? Or is it continuing to accelerate?
Good job it didn't come before the meeting because we might get that Wall Street Journal story again ahead of the meeting, 2 days before it, and whipsaw us all.
No,
Bramo, thank you. Nothing at all to see there. Lisa, thank you. Tom, looking ahead to GDP on Friday. Bank of America, TD, Deutsche Bank, Nomura. Just going through some of the estimates, all looking for that second quarter of negative growth.
Well, it's a second quarter of negative growth, but I'd say it's a pretty high dispersion. And again, it gets recalibrated along the way, a second look and a third look as well. But I take the point that the economic guesstimates are going to fold right in to what the stock market calls will be.
We have a new guesstimate, a new stock market call, Tom. S&P 500 year-end price target 4,200, down from 47. It's Laurie Calvasina of RBC, and she joins us right now. Laurie, great to catch up with you. Why the downgrade? Let's start right there.
So look, I think that targets are always challenging in years like this. And frankly, the market broke lower than we thought it would earlier in the year. What we wanted to do with this target was signal that we do see upside between now and year end. We think there's a decent chance stocks bottomed in mid-June. And if they didn't, we think we could probably get that before the end of the third quarter. But really, we wanted to send the signal that we thought there was some modest upside between now and year end, that we do think you need to be leaning into recession rebound plays as opposed to really kind of leveraging up on the defensives here, which we think are overbought and oversold. I will tell you, John, that some of my sentiment models tell us that my original 4,700 target's probably still the right one. But when we look at our cross-asset analysis, stocks versus bonds, that really does temper our enthusiasm a bit.
Laura, this is important. Davide Serra over in Europe this weekend aggressively writes, take risk in credit. Serra says grab a 6 to 7% coupon, get your foot in the water, let's go. You're saying the same thing on recession rebound. Yeah. What does a recession rebound sector or part of a sector look like?
So some of the areas that typically do well are things like financials and technology stocks. These are areas that typically underperform in the drawdowns and outperform on the rebounds. So those are two areas we like. We think the financials are dirt cheap at this point in time. Our banks analysts are very, very constructive and think that even if we do have a mild technical recession, that banks will execute very well through it.
Then how will you use the GDP statistics in review this week? I get it's a first look and all that, but if the banks are doing well, that means we underestimate the resiliency of the consumer. Do you buy that line?
I think that the banks are telling you, if you look through some of the reports that we've seen so far, is that the consumer is at a very good starting point to weather whatever this economic storm ends up being called. And I think that's one of the lessons that equity investors have learned over the last 4 or 5 years, Tom, is that every time we enter one of these dicey periods in the equity market, whether it was the trade war, whether it was the pandemic itself, whether it was simply sluggish growth out there, that the consumer is pretty resilient. And that consumer starting point does seem to be very, very strong right now. I think that's getting lost in some of these recession discussions.
Laurie, the big theme then, am I playing the inflation story still or pivoting to slower growth? Which one is it? A bit of both or one or the other?
I would a little bit of both. You know, we get asked a lot about stagflation, and what we've told people is that we do expect inflation rates to moderate, but they could stay high relative to history. For that, I think you want to keep some energy in your back pocket. I'm a little bit, concerned that we may not be out of the woods on energy in the very short term. But longer term, if we are in that stagflationary environment, I think you want to play there. I think that technology is a great way to sort of play that slowing growth theme. And we do see the market starting to shift away from these overvalued, overcrowded defensives back towards more reasonably valued secular growth areas of the market, like big cap technology. And I think that one of the things we've learned the last few years is that these big cap software companies in particular are the tools that companies use to fight just about whatever battle gets thrown their way. So if you think that we're sort of hitting the bottom in here, that we're going to get perhaps a better path from the Fed, that the consumer is going to stay resilient, but things aren't going to be all roses and sunshine, I think technology is an area you really do want to look at very hard.
Laurie, how do small caps fit into this, considering that you're now going overweight small caps heading into what most people think is a U.S. recession?
So look, I think you have to really evaluate what do you think has been priced into different points in the market, different parts of the market at this point in time. Covered small caps for a long time, Lisa. We know that they always have a very hard pivot midway through recession. They tend to really underperform hard heading in and on the way down initially, but they tend to really experience that pivot and outperform in the late parts of recession and on the way out. What we see in particular when we look at small cap performance against economic indicators like jobless claims and ISM manufacturing is that small caps are already trading as though we've had a spike in jobless claims and as though ISM manufacturing has plunged and hit typical trough-like levels. So I don't really need to have the are we having a recession, when is it happening debate within small cap. They are already pricing it in, and it's more clear to me in that part of the market than just about any other part.
Do you think that this means that small caps are ahead of the rest of the market, or is this a leading indicator that we're already in recession as it's going to get confirmed on Thursday with that second quarter GDP print?
I think it's going to be interesting if you do get a negative GDP print for the quarter, whether or not people view that as a recession. I think that debate will rage on. But I do think that small caps are very economically sensitive because they do have primarily most of their revenues coming out of the U.S. So if there was a technical recession in place, small caps were going to have sniffed that out. And it will really make sense, kind of the carnage we've seen in that space, frankly, since March of last year. it could make that, kind of move that we've seen make a lot of sense. But frankly, Lisa, it already makes sense based on what you're seeing in ISM manufacturing right now.
Laurie, great to catch up with you, and thank you for issuing the downgrade before the appearance, and unlike some guests who do it after the interview. Yes. Laurie Calvasino of RBC. Tom, I never understand what's that about. You come on for the interview and then you cut your forecast.
About lawyers.
An hour later.
This is really important question, John.
Clear it with them before.
What are you talking about? It's about lawyers. They don't want to get out front with the media. They've got to get in a process where it's approved up the food chain, and then it goes out to clients first. It's really, really serious.
Just want to bring out this headline for everyone. It's from Greece. Last week, the EU came out with this proposal to cut gas use for the continent through the rest of this year. And we talked about the potential for tension between the south and the north, the core and the periphery. Lisa, this from Greece. We can't accept the EU proposal for a 15% reduction in gas use.
So we have this idea that the European GDP could get cut pretty dramatically if Russia cuts off gas supplies, especially if it's a cold winter. So trying to get ahead of that. And already you're seeing countries push back and say, come on, guys, really? Give us a bone. Throw us a bone. Do we really have to do this? And it raises questions about longer term, how they can really build supplies ahead of what could be a cold winter.
Well, the data's already terrible. Let's put it that way. German business confidence has really rolled over. And Tom, the tension's pretty clear between a hawkish central bank and some weak economic data in Europe, and for that matter, in America too.
And then the war. I think over the weekend, I read a lot of the war over the weekend, John. I think there's a massive case of the war being distant, the war being removed from London, removed from New York, and that's probably at your hazard.
Euro-dollar 102.38. Lisa, welcome back.
Thank you.
Did you see the level of gloom there? John, I think the gloom clicked in about 6:01.
In TK, she came bouncing in.
6:01,
bouncing, smiling.
She just rocked
She was so happy.
It was just great gloom, and there it was.
And then the show started.
That's Wall Street.
It was about 6:01:32.
It was.
Oh, come on. I was smiling, though, as I said it.
It was smiling gloom.
We appreciate the smiley gloom. Futures up 0.4 on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The European Central Bank may not be done with big increases in interest rates after last week's half-point hike. Governing Council member Martins Kazaks has told Bloomberg that the rate increase in September also needs to be quite significant. The ECB is trying to reduce inflation that is already more than 4 times its 2% target. Now, Treasury Secretary Janet Yellen says she does not see any sign that the U.S. economy is in a broad recession. Yellen has told NBC that the U.S. is likely to see some slowing of job creation, but said that isn't a recession. She also expressed confidence in the Federal Reserve's fight against inflation. Here in the UK, Liz Truss says if she is the next Prime Minister, she would introduce low-tax investment zones to spur economic growth. The Foreign Secretary is leading the polls to succeed Boris Johnson. Her rival in the race, Rishi Sunak, has pledged to crack down on China's influence in the UK. He calls it the biggest long-term threat to Britain. The Director General of the World Health Organization has declared the monkeypox outbreak a public health emergency of international concern. The virus has spread to about 16,000 people in more than 70 countries in just a few months. There's concern that, as in the early days of the COVID outbreak, there's a lack of urgency and coordinated testing and treatment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Everyone's looking for another rate hike this Wednesday.
Central bankers basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
I would say that we're seeing a slowdown. A recession is broad-based weakness in the economy We're not seeing that now. I'm not saying that we will definitely avoid a recession, but I think there is a path that keeps the labor market strong and brings inflation down.
GDP is coming out on Friday. That was Janet Yellen, the U.S. Treasury Secretary, on MVC over the weekend from New York City this morning. Good morning. Here's the price action. Futures up 0.5% on the S&P. On the Nasdaq 100, up 5 or 0.6%. Yields higher too by 5 basis points, 280 on a 10-year. Crude up 1%, 95.65, and the euro showing a little bit of strength as we get a couple of ECB policymakers talking up another big move in September. Euro dollar 102.34, up 0.2%. TK, if we get that negative print on Friday for the second quarter, the second consecutive quarter of negative GDP in America, expect a ton of pushback that sounded a lot like Secretary Yellen over the weekend. Can you call it a recession when we just churned out 372,000 payrolls growth and we're looking for another 250 for July?
Reason to stay with us on TV and radio. Bruce Kasman's going to join, I believe, scheduled here. And JP Morgan really parses it out, John. And their nuance is, yes, domestic final sales seem to be a little soft, but they're looking for surprise and export growth. We will get to that with Bruce Kasman. They parse out, I believe it's a 0.7% positive statistic. It was an odd weekend. It started with a heat. For those of you worldwide, maybe you're cool, calm, and collected. We are not. Anne-Marie Horton down in a warmer Washington is not as well. It's basically survival wherever you are. But within that was a jewel of an essay by Stephen Eisenberg. He's out of Yale Law, but far more out of Newsday. And long ago and far away, he was an advisor to John Lindsay, who ran New York City for a while. And most importantly, Stephen Eisenberg is 81. And it was the most emotional essay, Anne-Marie, by someone of that vintage, of Trump, of Biden, and he just said, give it up, announce one term now, and then you can act with a new independence. Is that in the zeitgeist down there, or is Mr. Eisenberg alone?
He seems alone at the moment because many Democrats, while they do not want the president to be the leadership of 2024 and the candidate, according to a poll just 2 weeks ago from the New York Times, I think it was about 64% of Democrats say they want a new candidate for 2024. What you see in this Washington Post opinion piece, which is just telling the president to quit, is that he thinks that this would give him actually more freedom to come out and have more conviction in what he says, but then also at the same time, instead of whispers in corners of Washington, people able to actually come out and prepare a bench.
I mean, you're living this. The guy mowing the lawn behind you at 1600 Pennsylvania Avenue is very aware of the polling as well. Mr. Eisenberg talks about the urgent present. If the president came out and said, I'm one and done right now, what is the urgent present he must deal with?
Well, he's talking about the fact that he can come out with a lot of conviction and just deal with the issues at hand and not worry about the politics of 2024. The issue, though, which many advisors, I'm sure, would be telling the president, is that you then automatically become a lame duck president. Right? If you're not running in 2024, you become a lame duck president. But potentially what could help, and this is what the essay talks about, is that this could help other Democrats in midterm elections, because then potentially they're not voting on whether or not they like what is happening right now with the economy or a referendum on the actual individual sitting in the White House. They could vote potentially on those people running for legislature, whether or not it's for Congress or for Senate, and actual policies.
Anne-Marie, how vulnerable is President Biden after pinning a lot of his campaign to bringing down gas prices? Right now, that looks good, considering the gas prices have gone from about $5 on average per gallon down to $4.36 per gallon. How much do we look at something that is incredibly volatile, not in the control of the presidency, and could shift ahead of the midterms?
Well, this was obviously a huge goal of the administration. They wanted to quickly get gasoline prices down, especially during these crucial summer months when a lot of people are taking to the roads. And they were able to manage that. I mean, coming off a $5 handle is, for them, a huge milestone. And you could see that in the president tweeting constantly every time you see the cents tick lower on gasoline. Whether or not it has changed the psyche of the voters before November remains to be seen, but it's something that obviously they wanted to quell, because they just do not want this grumbling of people complaining about gasoline prices. But also, gasoline prices filter into everything else, right? This is a broader inflation story that they're trying to combat.
Lisa, energy companies are getting less greedy. That's what's going on over the last month. The efforts, I mean, surely it works the other way.
Well, okay.
Surely it works the other way.
Okay.
Does it not work the other way?
I get your point. And this is going to be something that's increasingly perilous as somebody tries to drill down and get some sort of logic behind some of the complaints that this White House has had. And I know that you'll be one of those people.
Well, if you spend months saying they're greedy, surely they're getting less greedy when prices come down, because that's all that drives prices, just the greediness of corporate
to that
America.
point, do you know that Friday we get Chevron and Exxon earnings? So we get a chance
We'll see
to
the
hear
greed of those
or
companies
not, or
later
perhaps
this
they're getting less so. Maybe we'll hear
the greed
from the
of
White House.
Apple later this week too. I just need to point out that GDP is on Thursday, as Lisa told you at the top of the show, and ECI is on Friday. So just quickly to you and AMH, if we get that negative print, did we get a hint from Secretary Yellen about how they might handle that?
I think that her interview over the weekend was certainly looking ahead and foreshadowing what they're expecting on Thursday. All the data in front of us shows this is likely going to be a technical recession. But what they're trying to, of course, get ahead of that is that, yes, maybe technically the U.S. Is in a recession, but that does not mean that there is this massive amount of slower growth, especially, and I'm sure they will say this, when you comparatively look at what is going on in other countries, namely in Europe.
Yeah, hard to call it a recession with unemployment at 3.6%.
Yeah.
That's for sure. Anne-Marie, thank you down in DC. We'll catch up with you in about an hour. Reflecting on some of the data we've had so far, the PMI services number last week, Tom, was dreadful. I mean, it was terrible. If you take out the pandemic months, and the team here at Bloomberg did that over the weekend, it was the weakest in records going back to 2009. That's how bad it was.
Yeah, I'll take that. It's back 12 or 13 years. But to look at the equation of GDP and the mix here, John, there's a part of America that's, even if we have a technical recession, whatever you want to call it, they're going to be fine. There's a huge part of America that the president has to address and others that's going to be flat on their back. And I would suggest, John, is flat on their back now. What we haven't talked about is one single item of inflation, and that is rent, and particularly lesser home sales shifting over to new renters.
How sticky will things get? And I think out of everybody, Lisa, you've done a great job of pointing that out over the last couple of weeks. That's going to be a big theme into year end.
A lot of people have been looking at that. How much are we looking at a technical recession that keeps unemployment low? How much are we looking at something more protracted? And that's tied up into the stickiness of inflation.
Futures up 0.5% on the S&P, on the Nasdaq up 0.5% also. Live from New York City this morning. Good morning. Heard on radio, seen on TV. This is Bloomberg Surveillance. I've always said it, the conversations in the commercial breaks with the guests are so much better than when they come live on air.
Well, I want to do that, John.
Why is that?
I want to do it like sports, John, where you go big box, little box.
We should do that.
And we show the messaging. Thank you to our great advertisers down low.
With
and
the
then,
mics turned up.
You know, they watch me stirring Tang and the rest of it.
I'm sure they'd love that, Tom. Futures this morning. Good morning to you. Up 0.5% on the S&P 500. Best week of gains on the S&P going back about a month. We caught up with Laurie Calvasina of RBC, who does cut her call year end from 4,700 down to 4,200. Earnings key. This week alone, 20% of the index on the S&P across just 5 names. We'll talk a lot about those 5 names in just a moment. I want to talk about the tension, the growing tension between hawkish central banks and weaker economic data, and talk about a 2-year in America. Thursday, Friday, that 2-year came in 25 basis points, and that PMI on Friday was pretty bad. We bounced back just 2 basis points, just south of 3% to 299 on a 2-year in America. That story, though, no different in Europe either. Growing tension between hawkish central banks and weaker economic data. As they focus on inflation, the output numbers keep coming in. Look at the euro this morning. Euro doing okay with some hawkish central bank speak, maybe supporting things for now at 102.21. But the data again, it was the PMIs last week, Tom. This morning, the IFO index, which is basically German business confidence, just doing that.
Yeah, I think our American audience really doesn't care, but the fact is German yields with a vengeance have come in. And, John, you know, I look at the Swiss 20-year, which came in with strong Swiss francs. So it's a movable feast in Europe, and I would suggest more movable right now, more dynamic than what we see in America.
For the multinationals, Tom, we've got to care. 1, earnings, and 2, FX. They're going to be important themes.
FX is tangible.
This quarter.
Yep, no question about that. Okay, let's do this right now. Let us get a handle on where we're going to the Fed meeting, and that involves actually doing economics. At Columbia University, he took macroeconomics, kind of sort of 301, and Bruce Kasman joins us now from a small bank, JP Morgan, this morning. I love it, Bruce. Ferroli says it's a kind of sort of recession. What kind of sort of recession is this?
Well, as you know, there's a good chance second quarter GDP will print negative for a second quarter in a row in Q2. As you kind of break down the data with job growth so strong, with what we continue to expect to be a positive consumer spending number in this week's report, it doesn't feel like a normal break into what we would call a recession. And I think we should recognize that about the first half. But at the same time, we should recognize the momentum loss that we had at mid-year. We're going to probably print a second negative consumption number in a row this week for June. As you've noted, the survey data for July, the flash PMIs were ugly. We're not just seeing that in the U.S., we're seeing it elsewhere, and claims are rising. So what feels like a technical event as we move through the first half of the year could easily turn into a real recession event as we go through the next couple of months.
In your spreadsheet, you've got a one-off on exports this quarter. Is it export growth to the rescue?
There is some support there, particularly as we see China and Asia lifting after what was a big second quarter set of lockdowns. But with the dollar rising and with Europe very much in the crosshairs of a recession right now, I would not be counting on exports saving us here. I think the saving grace has to be the business sector bending, not breaking in the face of the drags that we're seeing. Also, inflation coming off in the summer, with gasoline prices starting to move lower.
Bruce, I'm looking at certain data points. You're looking at the same ones. Claims are higher the last few weeks. The PMI last week was really bad. We're starting to see this show up in housing. Bruce, I'm trying to work out which part of this is desirable, the intended consequence of what the central bank is trying to do, and which part of it is undesirable.
Well, I don't think the movement towards softer growth is undesirable on the part of the Fed. That's what they want. They want to slow the economy. They want to take out the demand component of inflation. And then they're hoping that with the moderation of some of the drags gets you back to something more acceptable. However, and I think this is really what's behind your question, the momentum loss there, the idea that layoffs are starting to rise, that's starting to push together a dynamic which traditionally has been recession. And recessions, we should understand in U.S. context, is a breaking. It's a move up in unemployment rates of 2% or more. That's the risk here, is that we're letting something take hold here that's going to give us a much sharper move than anything like what you might characterize the first half of the year as looking like.
Embedded in John's question, Bruce, is the fight that is articulated in an article on Bloomberg. The houses of Morgan divided, Morgan Stanley disagreeing with your own JP Morgan on when the Fed is going to reverse course, pause, and then start cutting rates after raising rates. At what point is the softening that we're seeing in data now reflective of a Fed that will be able to backtrack as soon as next year?
Well, I actually think it's far sooner than next year. We're looking for 75 basis points this week. We're looking for more open-ended guidance. I don't think they're going to commit to a size of a move at the September meeting. September's a tough call. I think we probably still do get a 50 at the September meeting. But beyond that, if we're seeing the economy really soften, job growth slow towards zero, I don't think the Fed's going to continue to be tightening here at an aggressive pace. We've got them pausing at about 350. We don't have them easing at this point because we don't have a real recession call in our forecast. But I think it's about the economy. If the economy starts to slow, given that the Fed gets rates into a modestly neutral stance, the equation changes at the Fed. It's not there today with a 175 level of rates and an economy that's still generating over 400,000 jobs a month, but it will be there in 3 or 4 months if we're right.
Bruce, what's enough to cause the Fed to take a step back? I mean, is it an unemployment rate at 4.5%? Is it inflation coming down to 5% from 9.1%? How far do we have to see progress, and I put this in quotes, when it comes to the deterioration in momentum does the Fed have to see before perhaps taking a break?
I think the short answer to that is the Fed needs to have a policy stance, a trajectory on inflation, and dynamics on growth that gives them comfort that in a year to year and a half's time, inflation is going to be below 3%. 175 on payrolls, and the job growth we're seeing now is not there. 3 or 4 months from now, if payroll growth is down to 100,000 and the run rate on inflation with energy prices off is moving more into the 0.3% per monthly base, we think you could easily be in that zone.
Bruce, your update, please, on emerging markets. The currencies give way. I am told conversation after conversation, this time is different. All my radar's up.
Well, I think the currencies give way creates more risk here, especially since we're not going to see the relief on central bank policy. I think where this time is different is in the larger EM economies, and there is certainly a significant problem in low-income economies facing problems with food security and debt dynamics. But in the larger EM economies, you just don't have the debt overhangs. You don't have the current account imbalances. And you have policymakers that have been willing to continue to use fiscal policy. So growth is slowing. EM is certainly a threat if the U.S. and Europe go into recession, and we shouldn't lose sight of the European recession story. But we don't think there's a systemic magnifying effect through credit, which is often the case when you see some of these dynamics take place in EM.
Bruce, where is the leverage right now? Can we finish there? Because whenever we talk about this recession story, you've acknowledged the risks in America, you've acknowledged the risks in Europe, in EM, yet we keep hearing the same thing, that consumer balance sheets are strong, corporate balance sheets are strong. Where do you think the leverage is going to show up?
Well, that's the interesting question, is are we going to see the dynamic on growth, which still has a healthy private sector, sort of cushion here? Is that going to get magnified by credit? It certainly isn't happening yet, but there's certainly signs of stress building. And, I think there's always the underlying point here. When you're raising interest rates and slowing growth, you can be surprised at where something shows up that doesn't seem to be a big story. I would worry about European banks here in an environment in which we're seeing, I think, more sharp slowdown in growth, and we're just getting the ECB going. I'd worry that some of the smaller EM economies show more tendency to spill over in ways we're not expecting from a geopolitical point of view and from a credit market point of view. There are things there, but I'll tell you for sure, I always am surprised where these things show up, but I think we shouldn't lose sight of the context that this is an environment where that's a likely outcome.
Hey, Bruce, awesome to catch up, to get your views on a range of things. Bruce Kasman there of JP Morgan. That was just as good as the commercial break, Tom, just as good as the conversation in the commercial break. This Fed meeting this week is not about this Fed meeting this week. It's about the next one. It always is, September 21. And before we get to September 21st, Tom, you've got an August 10th CPI print, a September 13th CPI print. And I think to Bruce's point there, maybe the labour market's going to take on increased importance over the next 3 to 4 months. August 5th payrolls, September 2nd payrolls. Will this Fed be confronted by slower jobs growth, maybe even negative jobs growth by the end of this year, Tom, as they try and tackle inflation?
You outlined, John, what we are all doing now. We've joined Jerome Powell in being massively data dependent. And we just have to wait to see what the data is. We can guess on it. JP Morgan sub-headlines on Friday that recessions are always disinflationary. Okay, so we've got a slowdown, but are we disinflating down to 7%, 5%, 3%? It's a guesstimate.
Tom and Lisa, I'd love your view on this. I think some people might be screaming at the TV, at the radio right now saying, no. Chairman Powell joined us to be data dependent because he ignored the data for the whole of last year.
I imagine they might be screaming for a whole range of reasons, that among them, and that has been a constant theme. If you're data dependent, what data are you looking at? That's why I'm curious about the ECI that we get on Friday, the Employment Cost Index. How much does that feature into the belief that's frankly hardened into the markets of a Fed pause as soon as next year, even though a lot of people think there's only a 40% chance of a recession in that time?
Because he told us that ECI print was responsible for the Fed pivot at the end of last year. Do you remember?
And the University of Michigan sentiment survey was responsible for the increase that we saw just a few months ago. So which data?
Just cherry pick it and pick whichever one you want. Look, I get the data dependent thing, but as I said a million times last week, Tom, if you don't understand the reaction function, then what's to see here? Which data point matters?
Don't think there's a reaction function coming out of the pandemic, and with the huge fiscal impulse we've had, this is all original.
That's super helpful, isn't it? Futures up 0.4 on the S&P from New York. This is Bloomberg.
Keeping you up to date with the news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve will probably have to inflict much more pain on the economy to get inflation under control. After raising rates in June by the most since 1994, policymakers are expected this week to approve another 75 basis point hike, and they are likely to signal their intention to keep moving higher in the months ahead. Now, the US says that a Russian cruise missile strike on the port of Odessa has cast doubt on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed after months of talks. Russia says the missile attack targeted Ukrainian military infrastructure. Now, Hong Kong reportedly plans to reduce hotel quarantine for arrivals. According to local media, a two-color health code system will be introduced. One proposal calls for 5 days of hotel quarantine. After that, arriving travellers would be issued with the so-called yellow health code for 2 days that would prohibit them from entering high-risk areas. The Swiss bank Julius Baer has reported that net income fell 26% in the first half of the year, while market swings eroded assets that the firm oversees for the rich. The CEO, Philip Rickenbacker, has told Bloomberg TV he thinks the worst is now over. And Apple has announced a rare sales promotion in China. It's offering 4 days of discounts on its top-tier iPhones and related accessories. Apple is usually hesitant to alter prices, but it will cut $89 off the price of the iPhone 13 series. That suggests that there's a surplus inventory. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
I've been working to make sure that when the price of oil comes down, the price at the pump comes down as well and comes down in real time. The good news is that's happening, but it's not happening fast enough. We've made progress, but prices are still too high.
Gasoline prices coming down in America every single day since the middle of June. That was the President of the United States, and we wish him well as he recovers from COVID. Futures positive 0.5% on the S&P this morning. Here's the price action for you on the Nasdaq, up 0.5% also. Yields up by 5 basis points, just short of 280, 279.77. The data out of Europe not great again, but the central bank speak remains hawkish. Euro dollar 102.22. Tom, that's positive about 0.1%.
It is. It's what it is. We're resetting here this morning. And, John, what do you think? I mean, I've got an equity market lift. I got a VIX at 23.83. It's a bull market.
20% of the S&P reports this week, Tom, across 5 names. I think this
see.
week
Where
for
are we
earnings,
on Friday? Yeah.
Huge.
Yeah, absolutely. We agree with that, and we'll have all of that, including the big tech companies, for you. Right now in oil, Kevin Book joins us. He's head of research at Clearview Energy Partners. And I would suggest after the heat wave that we've all enjoyed, Kevin, we come back down to what I'm going to call partly July. It's 90 in Washington. Maybe it's 88, 90 in New York. Maybe it's 100 down south where it's supposed to be 100 degrees. How did we do in this heat wave? How did Washington do? Our grids do? Our climate policy do, given a real heat wave?
Well, the hot summer here in D.C. is when lawmakers try to get away. The whole point of August recess is to get out of here when it's hottest, but they didn't succeed in getting out in time. So they have to talk about climate. The climate policy did not stand up to the heat. I'd say it's safe to say that it didn't go where Manchin was expected to go. And so now we're back in the Manchinology game, wondering whether there's one more inning left to play.
Perhaps, Kevin, where climate policy did not go, the price factor did in terms of what people were doing when it comes to driving and the price response to the pump. Why have we seen gasoline prices go down? Is it purely because of the SPR release that we saw? Or is this because people are driving less, they are traveling less, they are consuming less in the face of higher prices?
Well, Lisa, can I say yes? The SPR is a real effect. You can't release 100 and some million barrels of crude oil, not have a price effect. But of course, on the gasoline response, you also have refined product inventories. Where were we a month ago? Mid-June, we were, 7% below demand cover a year ago. We're now 5% as of last EIA data above year ago demand cover. What changed? The answer is demand. Also, refineries running flat out. So you see both things. price response and 98% capacity utilization in Pad 1 and Pad 3, the big refining centers at the coast and in the Gulf Coast.
Kevin, how much do you see this as being sticky, as sort of being a continual decline in gas prices versus a pop, just in terms of the knee-jerk response to $5 a barrel, $5 a gallon, I should say, gasoline in the United States?
Well, the refining challenge hasn't entirely gone away. Again, if demand lightens and refineries are running flat out, then you get some balances in those inventories. But watch out for storms, watch out for unexpected downtime. In terms of the crude story, a lot of that has to do with the question of whether or not a price cap truly comes into place. And if not, whether the European sanctions that could drive prices up later in the year come to pass.
Kevin, do you have a base case for later this year in Europe?
Yes. Well, last week, the European 7th sanctions package pushed back a transaction ban on third country transactions for crude, Russian crude. That could be a preview of where Europe actually goes. Right now, Wally Adeyemo, the Deputy Secretary of Treasury, is in Europe to pitch the price cap. It doesn't look as though the price cap necessarily is getting a lot of uptake in the world, but the other option is for Europe to simply say, let's push back and wait.
If I look at climate change and the heat wave, what is going to come is more large heat, large cold, the greater dynamics that we have. Is our grid ready for it, Kevin?
Well, our grid is probably not the biggest concern in the world right now. I think the grid in Europe, for Putin to win on the ground in Ukraine, he's trying to win first on the grid in Europe. But here in the U.S., our politics about electricity are very, very fragile, very brittle. We expect electricity to work all the time, of course, and it's been very, very close. Cryptocurrencies shutting down in Texas to make the margin for things to work. Gas prices rebounding on the heat. We can see where the pressure is coming. And it's showing up in the CPI share that goes to utilities and to electricity and gas especially. You're starting to see a significant amount of America's pocketbook going into the wall and I guess to the burner.
Yeah. Kevin, awesome to get your view on things. Kevin Book there of Clearview Energy Partners, and Lisa at the heart of that conversation. A demand response this driving season. Do you remember that report from JP Morgan? They were looking potentially for $6 gasoline.
Yeah.
We got the demand response maybe a little bit earlier than they anticipated.
How much do we see a rebound then in the demand response if you start to see $4 a gallon? What's the price point at which people start to protest versus feel more confident to go out again? In other words, how much further down can prices really go if, as Kevin was talking about, we don't get that refinery response?
Europe, a key part of that conversation too. The politics of energy, Tom, in Europe later this year, it's going to be critical. Both Europe's relationship with the rest of the world and the relationships within Europe. I think the latter is where my attention is, at least right now, Tom, whether they can come together and form some kind of consensus about what they need to do collectively through the rest of this year.
I mean, I know they're way ahead of us in terms of conservation, but I just think this shock, it's a different story here, it's a different story there, John, but I would suggest the shock here is going to be completely wrapped around the changing of season and the fear of that cold, and that's going to happen sooner than later. It's not going to be October. This is going to be literally in weeks.
I'd love to catch up with Wally. You heard Kevin there mention Wally Adeyemo. I still don't understand that story, Lisa, how you can have some kind of cap on Russian crude. Why are they talking to the Europeans? Don't they need to talk to the rest of the world? Well, Isn't that where the lobbying effort really needs to be?
How about talk to Russia? Because Russia came out over the weekend and said, really? You really think that we're just going to say, sure, we'll take gas at 50% lower prices? Like, not a chance. We're not going to do business with you if you try to impose price caps. So where are they going to get the leverage to do this? And as you're implying here, it's China, it's India, and that's a pretty tenuous bet, considering some of the backdrop.
It's a story I just can't get my head around, but I'm open to explanations. Futures right now up 0.5% on the S&P and the Nasdaq 100. We're positive too by 0.5%. Looking ahead to Apple earnings later this week. And Tom, that story, when was the last time you heard a story about cuts to the price of the iPhone? Maybe the cheaper version, sure, but the premium iPhone cuts of up to $89 in China?
I saw that. It's in China, which is a different world, and it's a different market for them and such. What I would say, and this is like Dan Ives' territory and others, it's a complete mystery to me how that conference call is going to go. And it could swing either way. The uncertainty around big tech right now is just ginormous.
You don't usually see those sales, Lisa, on top-tier iPhones.
No.
Maybe the cheaper versions, but not like that. It's interesting.
The big question that I want to hear answered is how much is this a China-specific issue having to do with the lockdowns, and how much is this a broader slowdown in demand for the premium product of Apple?
4 days of discounts on top-tier iPhones in China. Ton of research on Apple going into the numbers. Two concerns. Foreign exchange being one, of course, and then the consumer, the strength of the consumer. That's going to be interesting. Throw in China too. And that's an important earnings release later this week. Futures positive on the S&P from New York. This is Bloomberg Surveillance.
Fed has to do its job, get inflation down.
The Fed is hiking interest rates into a known slowdown in the markets. This is something that they don't normally do.
We have heard from a lot of companies that they're thinking the following environment is going to be more challenging.
High inflation and policy tightening raises the prospect of a pretty significant slowdown.
We're seeing signs that global economic growth is decelerating at a pretty rapid clip here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures up 0.5%. TK, we've said it a few times already this morning. What a week coming up.
It's a big week coming up. It's sort of a nudgy Monday here. It's a nice time to recalibrate. That's been my theme here. And yes, the Fed meeting, clearly the key thing. John, we'll be doing that show. Remind Lisa that she's doing the show. Okay, very good. We got a great set of guests coming up. John, can I look at 12 months trailing? And the S&P 500 with a recent lift is a correction. It's down 10%. It's not that bad out there. I'm sorry.
We're being supported by lower yields, Tom, but lower yields are down because the data's weak. So what are you going to trade? The weak data? The lower yields? Do you think earnings have been resilient?
Yeah, I think earnings have surprised on the upside. There's a lot of people keeping micro score of this. I think Julian Emmanuel's doing a great job on it, and others. And the answer is earnings have been okay.
Is Snapchat your bellwether?
It is my bellwether.
Would you say that was okay?
It is. We're going to get to Ms. Hunt here in a moment, and she's heated on that. She says, Snap, can we all get over it? Snap is a bellwether?
Twitter. Bramo, looking ahead to Alphabet, Facebook. They're the heavyweights for ad spend in America and worldwide.
And as you said, 20% of the index is going to report this week, comprised of those 5 names, really, which are going to be coming out scattered throughout starting on Tuesday. How much do we get a sense of the slowdown in consumer demand that is going to affect some of the cash cows of the market that have not been priced in? And honestly, yes, people have been really resilient, and they've frankly shrugged off disappointments in earnings much more than in previous years. How much is this to basically where valuations are versus real optimism baked into something real?
That PMI last week was terrible.
Yeah.
I'm looking ahead to the ISM August 3rd on the services side to see if we get confirmation of that, because that was pretty brutal. Lisa, has anything changed for the Fed this week? 75, 75, teeing up a move in September?
They're definitely going to go 75. That seems to be the consensus across the street. They're basically taking the 100 basis point rate hike off the table. After that, how much guidance can they actually give? What data are they looking at? How much are they actually going to forecast anything at a time when there's so many moving parts?
Forward guidance is dead, Tom.
It is.
Big takeaway the last week, really, for the ECB too.
Please. I thought, there's a key thing out of the ECB. I mean, we haven't talked about TPI. How'd that work out? The answer is it was a very post-ECB.
What did Marcus Ashworth call it, Tom, to protect Italy?
Yeah.
TPI.
That's great.
Ahead of the election in September.
The first thing I looked at this morning was Italian spreads, which I guess are okay, is how I'd put it this morning.
Futures are okay, up 0.4% this morning. Good morning
a nice
to you.
Lift.
On the Nasdaq 100, up 0.4% also. Yields are higher by 5 basis points, 280 on a 10-year. Crude higher too, up more than 1%, 95.85. Euro dollar 102.33. Welcome back again, Bramo.
Thank you.
Good to have you back, Lisa.
It's great to be back. And honestly, today is not necessarily going to be a massive day, but this week, as we've been talking about, it's going to be a huge game changer on a slew of reasons. The first being these big tech earnings that we're talking about. Alphabet, Microsoft, Meta, Amazon, Pinterest. Why is Pinterest up there? I'm not sure. We also get Apple coming on Thursday. Sorry, I'm just going to be honest. I know that Tom really likes Pinterest. Tom, Pinterest fan?
Dow component.
Is that another bellwether for you, Tom?
It is.
Yeah, sure.
Exactly.
All right, let's move on.
Exactly.
Wednesday, we've got the FOMC rate decision and press conference. How much do they talk about not only inflation, the data they're looking on at that front, versus what they're seeing in the unemployment picture? How much can unemployment rise before they respond to that, in addition to just combating inflation? And this is the key aspect when people talk about when the Fed might dial back their rate hikes or even reverse them, which a lot of people in the market are baking in for 2023. And this week we get a slew of economic data. Interesting on Thursday, that second quarter GDP print for the United States, if it comes in negative, would mean a technical recession, 2 consecutive quarters of negative growth for the United States. We also get that key employment cost index on Friday, as well as the University of Michigan sentiment data. So, honestly, if we look at what the Fed is data dependent on, we've seen both of those indicators sway the Fed, at least post facto, with respect to their rate decisions. So maybe we'll get some guidance there for the following meeting in September, John.
I'll just be focused on Pinterest numbers later this week.
Good, I'm glad. Me too.
Lisa, thank you. Sarah Hunt joins us now, Chief Market Strategist at Alpine Saxon Wood. Sarah, your line. Wow, this market, like the weather in so many places, don't like it, wait a few minutes, it'll change. Do we have to get used to that, Sarah?
I think that we do, unfortunately. I mean, you've got so many different cross currents that are going on and so many different forces acting on the market that you have these little mini moments where it's all about inflation and then it's all about recession and then it's about the Fed and then it's about the ECB and then, earnings are okay, so that's all right. I think you're just in a period of volatility because you've got a lot of different things going on right now and people are focusing on them in different moments.
Sarah, you've got a great single line in your essay on Snap, and it's the level of Sarah Hunt's snark here, folks, is off the chart. Is Snap really a bellwether? Explain the massive divide you see now between substantial and persistent free cash flow companies and the rest of this noise out there.
Well, I think that's really the key. I mean, we've been talking about that since the beginning of the year, that really what you need to focus on is companies that have a business model that's been sustainable through a cycle. Because right now we do have a cycle of things that are slowing. You can argue about whether or not it's a recession technically or whether or not it's a slowdown, but it's definitely a loss of momentum. And we definitely see some problems in all of that. Now, what's the first place you're going to do? You're going to cut advertising, but are you going to cut it from Google first or are you going to cut it from other platforms first? And that was sort of where I was going with that, is that it's not so much about trying to be mean to Snap. It's just saying that, yes, if you're going to pull back on advertising and companies are going to pull back on spending, that's going to happen. But is it going to happen across the bigger platforms as much as it's going to happen across the smaller platforms? And I'm just not sure that's the case.
Well, Sarah, given that that's your perspective, how much are some of these bellwethers that are the big tech companies going to potentially shift the view in markets, be sort of a pivot point for the optimism that we saw last week going into the recession that so many people expect?
Well, it's interesting because even though Google had good numbers last time, the stock was higher on the numbers and then came down as tech came down. I think you're fighting two different forces, one of which is individual fundamentals for each of these companies, and the other one is technology as a whole versus interest rates and that cycle. And I think right now, technology as a whole is suffering under both the interest rate cycle and what I would worry about on the profitability cycle. But there isn't a lot of differentiation on the investor side yet. And I think that comes as we get further along.
Goldman Sachs has come out and talked about the dollar, the strong dollar, and how that's going to reduce earnings per share by 1% to 2% in a way that perhaps hasn't been baked in yet to valuations. How do you evaluate the dollar strength up until a couple of days ago and how that's going to factor?
Well, I think that, the faster that the higher the dollar has moved and the weaker other currencies are as much about there being weaker economies than the dollar being stronger. So the real question is, do people worry as much about the currency translation issue, or do they look at the United States and see an equity market that's in better economic shape than some of the other equity markets globally? And I think ultimately that will trump the factor of whether or not the dollar strong is a problem, but it is going to feed into earnings and not necessarily into ways that people have calculated yet.
Sarah, awesome to hear from you. Out of a massive week for earnings. Sarah Hunt there of Alpine Saxon Woods. None of us around these tables, thinks that Snapchat or Twitter are bellwethers. But ultimately, Tom, we do have to say, it's certainly sharpened the focus, reinforced the focus on Alphabet and Meta later this week.
John, I just flat out don't agree. I think the size here, granted, Facebook's got its own challenges. I get that. But I think the media conflation of all different types of tech is just way off.
Well, let me be more specific, Tom, since you disagree. Do you disagree with this? The ad revenue pieces of those two companies, that's going to be a big focus for a lot of people.
Yeah,
do you disagree with that?
I agree. And Amazon has their new burgeoning ad business. Joe Feldman wrote about that over at Telsey, I think 5 days ago or so. There are those three big digital players. I get it that they're the future of advertising revenue, if you will. It's worth watching, but there's so much more of a mix here. Look at Apple. Pre-pandemic, John, Apple was barely getting by with $59 billion of free cash flow. I mean, they're just barely getting by. We're modeling on the Bloomberg FA screen, John, $109 billion for this fiscal year ending this autumn. I mean, they're doing terrible.
Cash machine, Tom.
They're just.
We know how well they're doing. Tom, we know that.
Well, yeah, but we equate them to Snap, and I would
don't think
suggest
anyone's doing
listen,
that.
I think a lot of people in the parlor game of buy this, hold this, and sell that conflate all that stuff in, and I just don't buy it.
Snapchat and Apple, two companies, Lisa, I don't think either of us would ever conflate.
I'll let you guys work this out off in the break, but I do think that there is an issue here when you start to see the cash cows that we're talking about. And Tom, I'm glad you put that cash flow into perspective. What happens when one of those cash flow companies starts to discount items, not only in China, but plans to start doing it in the United States after basically seeing lines out the door to buy $1,000 products, no problem, just 6 months ago? What happens when Microsoft, also reporting earnings this week, also going to come out perhaps to talk about why they've been reducing their jobs plan, their hiring? How much does this serve as a massive bellwether, regardless of the cash flow that we know they have?
I don't think it's massive. I think it's at the margin, and what we know is if you bring out price of a product, unit sales go up. That's part of the, the elasticities there of price down. Maybe they sell a lot of units in China. I don't know.
I actually think on the hiring intentions headlines we've seen over the last month or so, might be good news for this Federal Reserve. I think that's the goal, isn't it? Just to take some demand away. To take some heat out of the labour market.
John,
I would say seeing those big tech companies pull back on job openings, not on their workforce, but on job openings, perhaps that might be seen as a desirable outcome.
I go with that, John, but like over the weekend, every single conversation devolves back to rent. That, what the Fed is really focusing on is taking the oomph out of the housing market, and that's going to go right into rent, and that's going to keep inflation up in OER.
Stickier for longer.
Yeah.
And that's shaping the debate about how far this Federal Reserve is going to have to go and why Citi and Andrew Hollenhorst are still at 4% year-end on Fed funds.
That's amazing.
I'll just say this. Every conversation had to do with rent because Tom tried to sell me an apartment.
I know he did.
To rent over the weekend. He actually
gave you a
brought
tour,
me in.
right?
He gave me a tour and tried to get me to join in.
And spend more money on rent.
Spend more money on rent.
A lot
so
more
that was
money
the discussion.
On rent. Futures up 0.5% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Treasury Secretary Janet Yellen says she does not see any sign that the U.S. economy is in a broad recession. Yellen has told NBC that the U.S. is likely to see some slowing of job creation, but said that is not a recession. She also expressed confidence in the Federal Reserve's fight against inflation. Now, the European Central Bank may not be done with big increases in interest rates after last week's half-point hike. Governing Council member Martins Kazaks has told Bloomberg that the rate increase in September also needs to be quite significant. The ECB is trying to reduce inflation that is already more than 4 times its 2% target. Here in the UK, Liz Truss says if she is the next Prime Minister, she would introduce low-tax investment zones to spur economic growth. The Foreign Secretary is leading the polls to succeed Boris Johnson. Her rival in the race, Rishi Sunak, has pledged to crack down on China's influence here in the UK. He calls it the biggest long-term threat to Britain. Elon Musk is denying he had an affair with Sergey Brin's wife, according to the Wall Street Journal. The alleged affair took place in December. The newspaper says it led Brin, the co-founder of Google, to sell his investments in Musk's company. Musk says the story is untrue and that he's still friends with Brin. Brin did file for divorce from his wife in January. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Everyone's looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg, your global business authority.
I actually think that just the right thing to do is to raise taxes right now to take some of the demand out of the economy.
Larry Summers there, always popular. The Harvard University President Emeritus and former Treasury Secretary. I don't think that's going to be popular at all. Futures on the S&P up 0.5%. On the Nasdaq 100 up 0.5% also. Yields higher by 5 basis points, 280.32 on a 10-year. Crude up to 95.60, up 1%. Data out of Europe, not great. German business confidence soft, rolling over, sinking. 102.44 on euro dollar, Tom. We're positive there. 1/3%, with one ECB policymaker this morning pointing out that maybe the big hikes aren't done with the first one, and we could get another one in September.
You know, the parlor game front and center today, I just look at the pricing and to see West Texas Intermediate 95.64 is certainly a welcome sign. I'd also know copper, barely have looked at that today, John, but copper, I'm going to call it stasis here, EM sort of stasis on a hot Monday as well. Heat wave may be ending across the East Coast this morning. Emery Horton knows this. She's living it. She's in it. 1600 Pennsylvania Avenue, and joins us cool, calm, and collected this morning. Emery, August is a time where you sit back at the White House and try to figure out the plan for September. What is the plan? What is the urgency to change the bodies in the cabinet and the bodies at the White House?
Well, first, we should know that there's a lack of urgency at the moment for anything at the White House because the president is still in isolation. He's quarantining because he has COVID-19. Virtually, yeah, he's joining meetings and everything virtually, working around the clock, the White House says, more than 8-hour plus days. For September and October, it's really going to be about, and you already started to see this when the president came back from his foreign trips, making sure that he is making this crucial domestic stops because they are concerned about the midterm election. Everything from now on is going to be about the midterm election. You have the House and the Senate also rushing to get a number of bills done before they go on August recess because they know when they come back, everyone is just focused on getting reelected.
I mean, over the weekend, I don't want to get into this right now, but the former president may run, should he announce, before, after, I get all that. Bring that over to the president of the United States. What do Democrats want from their leader?
Well, if you're talking about running for re-election 2024, a majority of Democrats, and this was a poll the New York Times and Siena College did about 2 weeks ago, do not want him to run. They think that there needs to be a new shift in the leadership, and it's not exactly personal, but he would be in his 80s if he was going to be rerunning again for 2024, and they think that there just needs to be a new leadership for the Democratic Party. The issue, of course, you have, if the president does come out and says he's not seeking re-election, does that make his presidency an absolute lame duck? But others, like we saw in the Washington Post over the weekend, think that actually it could give his words some more conviction, and then it gives the Democrats to openly talk out loud what you hear them whispering in corners of Washington, which is how to prepare a future bench.
And Marie, given this soup, why is Nancy Pelosi going to Taiwan?
Well, we don't know exactly yet if for sure she is going to Taiwan. She's taking a trip to Asia, and she's supposed to be going to potentially to Taiwan. But the president had said that the military has advised that that's not a good idea right now. And then the fiery rhetoric just continues out of Beijing. This morning, we heard from the foreign ministry spokesman saying they are getting strongly prepared for this visit. She clearly wants to make a stance about standing with Taiwan. It would be, though, quite a political statement. We haven't had a Speaker of the House go to Taiwan since 1997 when it was Newt Gingrich. And at this moment, there is a lot of issues, combative issues between Beijing and Washington. But we should also note this is useful for Xi Jinping at the moment. He is struggling domestically with the COVID-0 policy, what's going on with the mortgage rates, a number of issues, youth unemployment. And now he's able to deflect a lot right now on this relationship. And he, of course, has a key party Congress coming up in the fall.
When I call this a soup, it's also a soup when it comes to the U.S. relationship with China and also the weather, but having to do with how they're going to deal with tariffs, how they're going to deal with the trade relationship at a time of increasing fraying, as well as a possible partnership between China and Russia that's really ruffled some feathers across the world. Where are we in terms of the tariffs and lifting those on Chinese goods to possibly ease some of the inflation domestically?
It's a great question. We still don't know. The administration still continues to come out and say they're weighing it, but we have yet still no clear decision on what they're doing on not all, but what would be a smaller amount of the Trump-era tariffs, consumer goods like bicycles, sweaters, et cetera, because their number one concern, they say, is inflation. So many on the economic side of the administration say if that is your number one concern, this is something you could do. It won't be a lot of pressure, but it could ease some of that pressure. While you have others in, the trade czar, of course, Ambassador Catherine Tai, and others saying that leaves us with less leverage at the negotiating table. But so far, we do not have an answer. But what we can expect in the coming days, the president had said, is that he has an intention, expects to speak to President Xi Jinping. So maybe some news on that front soon.
Anne-Marie from outside the White House. AMH, thank you. Bramo, to your point, the tension with Speaker Pelosi and President Xi, that's the oldest playbook in the policymaker's book, isn't it? Weakness at home, double down on tension abroad.
How much, though, is this going to benefit versus backfire? And Anne-Marie was talking about some of the military warnings. Mark Milley, who's the chief of the armed forces for the United States, came out and said that Chinese officials and Chinese military aircraft were intercepting U.S. aircraft more aggressively than they've seen in a long time. How much is this aggravating some of the tensions that have been escalating in any case that are going to be very difficult given the conflict already happening with respect to Russia's invasion of Ukraine?
TK, what do you make of this?
What I make of it is everything is about the party Congress. Elizabeth Economy is absolutely definitive on this. And as Anne-Marie said, we are completely fixated on the permanence of Beijing. The Chinese aren't.
The vulnerability of President Xi is something that comes up with Chinese watchers, China watchers again and again, Tom.
Yeah, way below the radar, and it's something we've got to be aware of. I don't have any strong feeling on Taiwan, other than it's been there since my childhood, the whole debate about it. But I think the real focal point has to be on watching China. We've given up doing that because we believe there's a permanence to President Xi. I don't buy it for a minute.
Colin Martin's going to be joining us a little bit later. He'll weigh in on some of these themes from the Schwab Center for Financial Research. Ahead of that, futures up by 0.6% on the S&P and the Nasdaq 100. A lift up 0.5%. Yields a lift up 5 basis points. You sense a theme here, Tom. 280, 32 on 10s. Crude, a lift.
John,
at 1.2%, 95.86.
My study this weekend is just, do I extend out to Forple leveraged all cash?
Oh, really?
I'm not there.
Quadrupling down.
Yeah, I'm not there. I just stasis.
How are you the acme of optimism? Quadruple leverage cash, really? And then you're going to tell us it's all about the cash flow of these companies that are doing so well.
I've missed you.
Data.
You're saying that Tom's position and his view doesn't...
John, Google. I mean, come on. Google. Pre-pandemic, $1 gazillion of free cash flow. Over double now. 74 billion. Wow.
Bramo is so excited about Pinterest earnings later this week. She's buzzing. Big week ahead for earnings. 20% of the S&P 500 reporting across 5 names. 40% of the Nasdaq 100, those same 5 names. Futures this morning up 0.5% on the S&P and the Nasdaq up 0.5% also. Bit of a bounce back. It continues after a big week of gains last week. The biggest week of gains on the S&P going back to June, about a month ago. In the bond market, we talked about this all morning. It's the growing tension between weak economic data and a hawkish Federal Reserve. Is that desirable or undesirable? The intended or unintended consequence of what they're trying to achieve here. Jobless claims climbing for 3 straight weeks. A really, really weak PMI print last week that we can continue to talk about drove yields lower at the front end by 25 basis points on Tuesday, Thursday and Friday. This Monday, up by 3 basis points. 10s up by 6, 30s up by 8. The curve just getting a little bit steeper. For the euro, more weak data to talk about and more hawkish central bank speak as well. Euro dollar looks like this at 102.48. German business confidence, Tom, terrible. Yet, we still have one policymaker this morning talking up another big move in September. How much weakness is this ECB willing to hike into?
I mean, I'm glad that they're talking it up and they're having visibility, and I guess that keeps it going forward. But I think, John, again, as we've said through the morning, they're as data dependent as I've ever seen 20, 30, 40 years. This is different than 1994. They got to wait for the data.
Which data are they dependent on, Tom?
Their
which
GDP.
Are they willing to ignore?
Well, they're politically hydrocarbons, gas, coal, and all that. But I think it's a much more GDP-sensitive analysis in Europe in war than it is here.
Futures, positive. The euro, just a little bit stronger. That's your cross-asset price action. Let's get you some single names. We can do that with Lisa.
Starts
hey, Lisa.
Thanks. I'm just going to have a wall-to-wall Pinterest. So rip up the script and talk about how to plan for kitchen renovations. What I'm looking at today are a slew of the big tech names that are going to be reporting this week. Apple shares up 0.6%. Alphabet, Google up 0.7%. Microsoft 0.5%. Not massive. What I'm really looking for this week is how much has already been priced in. Apple has performed the best or the least worst among the big tech firms. How much are we talking about sticky desirability of the iPhone, regardless of the economic cycle, regardless of any price increases? And how much does that news out of China of Apple cutting prices indicate something broader versus a China-specific story? Also this week, we're going to hear from a number of the commodity producers, starting off Wednesday with Rio Tinto. How much do we see the increase in the prices of iron ore, the increase in demand, paired with the slowdown that we're seeing in China, really come to a head with some sort of forecast from Rio Tinto, one of the biggest miners in this area? Those shares up 3.3% today ahead of the open. And Exxon and Chevron reporting on Friday, a very politicized issue, as we were talking about earlier, Tom, considering that the president has talked about price gouging and greedy oil companies. How much do they represent that greediness and profitability at a time when they've already had stellar years, particularly Exxon? Those shares up 0.7%, and Chevron up 0.8%, despite the fact that crude on the NYMEX is down at the lowest levels going back to February.
Thanks, Lisa. It's going to be interesting to see the oil as well, but I'm all tech this week. That's what we're going to focus on into the Fed meeting. Right now, with the Bloomberg Total Return Index, the corporate index, the IG index, down 13%. It's a good time to catch up with Colin Martin, fixed income strategist at the Schwab Center for Financial Research. Colin, to cut to the chase, I'm opening the envelope. I'm 3, 4, 5 months, even a year down in my bond portfolio. How do I begin to recover?
Ooh, well, you need time, unfortunately. And that's the one thing that we're telling our clients. That's the good thing about bonds, is that their prices should recover and accrete to par. That doesn't necessarily help if you're in a bond fund or an ETF, and that's always a challenging aspect because those prices don't necessarily need to rise up. They might not recover anytime soon. That is the challenging part. And what we're trying to tell our clients is to stay diversified. And coming into this year, we did suggest a slightly lower than benchmark average duration. While that might have helped a little bit, but unfortunately, those returns are still down pretty sharply also. But the good news is that yields are pretty high right now. I mean, they're near the highest they've been since the end of the financial crisis. So we think it is an opportunity for investors who have been waiting on the sidelines. And frankly, we know that there are still a lot of clients, a lot of investors who've been waiting for yields to rise. And we think now presents a pretty good opportunity.
Where in the continuum from Apple at 0.5% yield, let's just as example, out to a very distressed energy item not taking part in the energy boom, where in that credit continuum is the best value?
I'll take the easy way out and say probably somewhere in the middle. We do prefer investment grade over high yield right now, and we're okay taking some BBB risk or single A. I mean, that makes up the bulk of the market anyway. We are cautious on the junky issues out there, especially anyone that's distressed right now. We're seeing in the earnings reports right now that earnings are pretty disappointing. We're seeing costs everywhere rise, whether it's labor costs, input costs, and now borrowing costs. So all those things are going to eat into corporate profits, and the demand outlook isn't too strong right now. Meanwhile, we've seen spreads fall pretty sharply over the past week or so, and the value proposition just isn't too attractive right now. With high yield spreads back below 5%, given all the economic risks we see out there, the risks to corporate profits, we'd rather wait for spreads to move up a little bit, for yields to move up a little bit before we got a little bit more excited about high yield bonds.
Colin, let's dig into this a little bit more. We're watching the biggest monthly rally in junk bonds, potentially if this continues, going back to April and May of 2020 when the Fed unleashed its bazooka to try to save markets from the pandemic. How much is this a signal, this rally, of something that's giving the stock market and broader risk assets confidence versus high degree of noise, a lot of investors just taking yields because they haven't seen it in so long?
I think it could be the latter, Lisa. Yields did jump very high, and just on an all-in yield basis, high yield bonds were offering yields close to 9%. And any way you slice it, that clearly is an attractive number, even if the risk outlook is negative. It's just a high number. I think we can point to the Fed also. Over the past month or so, we saw expectations surge about how high they were going to hike. And then they've come down. And that maybe gave the markets a breath of fresh air that the Fed wouldn't necessarily need to hike as much. But we're just still concerned for those confluence of risks that I've mentioned before. If we look at previous periods over the past, say, 20 years or so, peaks we've seen with high yield bond spreads, they're well above where they are right now. Now, we don't think we're going to the 08-09 levels, or probably even not the March 2020 levels. But upside of 200, 300 basis points seems likely to us. So we'd be kind of on the sidelines right now and wait for a better opportunity to dive in.
Colin, it doesn't sound like you're particularly alarmed, especially when you try to draw the distinction from what we saw in 2008 and 2009 and the big swings there. Bruce Kasman of JP Morgan earlier said that he's also looking for areas of leverage, not seeing them necessarily in credit markets. Are there any areas in the debt complex that are different, that might have the nodes of something that could be more contagious and more difficult?
We're really not seeing that too much either. Our outlook is, it is more negative because we see risks on the horizon. We expect growth to continue to slow. When we talk about contagion, depth of the recession, we don't think it's going to be that bad. We think it's going to be more mild. That should result in some sell-offs, but not, end of earth type sell-offs or get out of every type of investment you have. So that's the good news. And again, just to reiterate our main point, we do think it should present opportunities, hopefully sometime later this year.
Colin, awesome to get your view on things as always. Colin Martin there, the Schwab Center for Financial Research. Bramo, I spoke to 3 people late Friday. Spoke to Marilyn Watson of BlackRock, Mike Collins of PGIM. I spoke to George Bory of Allspring. All 3 of them said that they think we've seen the highs on a 10-year this year. Mike Collins said for the cycle, over. That was it, close to 350. All 3 of them said that we have not seen the wides of the year on high yield, pushing back against that 100 basis points of spread tightening we've seen over the last month or so.
If you think about it logically, if you think about the credit spread representing the risk that companies face, why would it be contracting, less risk heading into a recession and a weakening economy? That doesn't make a lot of logical sense. So to sort of edify what they're talking about, that would be the reasoning to push back against that. That said, if the Fed starts cutting rates next year, how much of a support, a reversal does it give to companies who are already well-financed into perpetuity?
You've got to make a call on how much damage is done in between to the economy and what the earnings profile of some of these stories will look like, Tom.
I would look at the damage done in bond portfolios, John. I've been talking about this from day one. You look at the Bloomberg Total Return Index. I just looked at one healthcare name down 22% at the bottom. This is a AAA, not AAA, it's inaccurate, but it's a really high quality name, down 22%. Now it's down only 13%. It takes 5 years of the present yield to make up the drop that you see. Now, granted, that can happen shorter. I get that. But the bond bear market we're in right now, John, is absolutely
There's
original.
some real damage done, Tom.
Absolutely original.
All on the same page there. Yeah. TK, is the ECB going to help out? You'll love this. The Latvian Central Bank is speaking a lot this morning of the ECB Governing Council. We will know fragmentation when we see it. Tom, that's helpful, isn't it?
Oh, the great John, you know him so well. Willem Bouter. I put it out on Twitter this weekend, Project Syndicate. I'll put it out again, folks. This is what Bouter's famous for. This is why he's Willem Bouter. He just simply walks through the foolishness of it. And he does it with respect, John. He's not bad-mouthing anybody. It's classic Willem Bouter.
The most effective backstop,
phenomenal.
Tom, is a backstop you never have to use. right? We'll
yes,
agree on that.
Alan Meltzer 101.
Willem would agree on that.
Yeah.
They've clearly come up with a tool they don't ever want to have to use, right? Because they're telling us very little about it.
I'm sorry. Willem Bauder just does it great. It's like, I think of Klaus Regling, John, who we talked to at Davos. These guys, they got to be just shaking their head.
Futures up 0.5% on the S&P, on the Nasdaq up 0.5% also. You know it when you see it. Fragmentation, Lisa. Fragmentation.
Yeah,
you
no,
missed it. You missed a great one last week. You really did.
Political risk. TPI. I like that.
Did you miss that Thursday,
don't
Friday?
go away.
I did.
I know you were just a little bit jealous
Oh yeah.
that you weren't watching that news conference.
Yeah, I was measuring my oxygen levels.
This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve will probably have to inflict much more pain on the economy to get inflation under control after raising rates in June by the most since 1994. Policymakers are expected this week to approve another 75 basis point hike, and they are likely to signal their intention to keep moving higher in those months ahead. Now, the U.S. says that a Russian cruise missile strike on the port of Odessa has cast doubt on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed off after months of talks. Russia says a missile attack targeted Ukrainian military infrastructure. Hong Kong reportedly plans to reduce hotel quarantine for arrivals. According to local media, a two-color health system code will be introduced. One proposal calls for 5 days of hotel quarantine. After that, arriving travelers would be issued with the so-called yellow health code for 2 days that would prohibit them from entering high-risk areas. A Bloomberg exclusive today, the investment bank founded by billionaire Ken Moelis is starting a group to focus on global blockchain deals. Moelis and company is beginning its effort in the middle of a so-called crypto winter venture. Funding in the industry has tumbled. Meanwhile, the price of Bitcoin has plunged to less than 1/3 of its record high of more than $68,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I think inflation is going to stay. At least some of it, labor is going to get more expensive. The big question is, will we have a recession or not? I think current signals are no. There might still be a soft landing, but you never know. The percentages change fast. So I think clients need to prepare for different macroeconomic scenarios.
Philip Rickenbacker there, the CEO of Julius Baer. From New York City this morning, good morning. Futures look like this, up 0.4% on the S&P. On the Nasdaq 100, a lift up 0.4% also. Building off the back of the week of gains we had last week. Yields higher by 6 basis points on a 10-year, 281.23. The curve a bit steeper today, higher at the long end on 10s and on 30s too. Euro dollar, positive 0.25%, 102.38. Line of the week so far. Early in the week from Peter Cheer of Academy Securities. Tom, stay out of the heat, read a good book, don't light $100 bills on fire, and hopefully we get more clarity on the Fed later this week.
That is the smartest thing I've heard this week. I mean, I really can't say enough about that. I guess the heat breaks today here in New York.
Hopefully so.
Washington's brutal. Stay cool out there, folks. Right now we touch on China. Here's Kriti Gupta.
Yeah, we have to talk about, well, China in relative to the bull case for U.S. Treasuries here, because that's been a trade-off that has been at play in the bond market. If you are looking for yield, where do you invest in the bond market? Is it Chinese bonds where you get that extra kind of EM yield premium, or is it the U.S. market where you do have an extremely hawkish Federal Reserve and really take advantage of those interest rate differentials? Well, that brings me to my chart of the day. We are looking at the U.S.-China yield differential. Essentially, when we're looking at a zero line, when the line goes up, it goes over that 0-point line, you do see that there is this kind of extra premium for U.S. Treasuries relative to China. When the line drops down, it's the opposite. And right now, it is hovering at zero. It's a key point, Tom, when we're talking about the bull case for Treasuries, once again, here in the States, at a time when people are perhaps a little bit hesitant to invest in Chinese bonds. Do you stay with the U.S. story, but then at the expense of perhaps lower yields?
Yeah, and then China as the nexus for Pacific Rim as well. Kriti, thank you so much. Right now, Andy Curran with us. Bloomberg Chief Asia Economics Correspondent, and there are lots of themes to talk about. Lisa and John are going to touch on that. I want to get out front in July towards the Party Congress believed to be November. This is the 20th Party Congress of the CCP, the Chinese Communist Party. And the great distinction seems to be what will happen with President Xi and the symbolism of a general secretary or perhaps being a chairman as Mao was in 1982. Tell us about those niceties of a party Congress and what they do with their fearless leader.
Well, the party Congress, Tom, is the all-important. Every 5 years, the top members of the Communist Party come together, and it's where, of course, they basically agree on the new government, on the new leadership, the General Secretary and the Standing Committee, and then they push forward for the next 5 years ahead. The difference this time around is normally it was expected that it would have marked the end of President Xi's term, but as you mentioned, all the expectations are he will be getting that third term, which is in recent times quite unprecedented, but he won't be just getting that third term. There will be a lot of language getting codified as well, which will basically be installing President Xi as China's probably strongest, most dominant ruler in several decades. You could argue going back to Mao, scholars have different views on it, but certainly it will be, as I say to you, it won't be just a new term. It will be enshrining his place in the future development of where China is going under Xi thought, under this new era, and all the rest of it. So it'll be a show of strength, and it'll be quite unprecedented in recent times.
Are the present domestic difficulties in the way of President Xi now? Is there an urgency to fix July to get to November?
You would have to say there is, Tom. Every country has their realpolitik now. Obviously, as we know, with China, it's always hard to gauge what's going on with public opinion, and we know the authorities are in complete control. But going into this year, it was meant to be all about stability. That was one of the buzzwords last year, but they've had several hurdles this year, as you mentioned, of course. The arrival of Omicron has really tested the aggressive COVID-0 strategy. That's hammered the economy. You've had the ongoing real estate slump, plenty of unhappiness among people on all of those fronts. You can judge that by open source social media. And of course, the geopolitical backdrop hasn't at all really improved either. Lots of tensions with the US and Europe. So I would say that realpolitik would say, yes, the authorities are quite keen to stabilize things, especially on the employment front and on the economy front, and to build into the Congress on a good base. But I would say, though, it's worth remembering when we do talk about COVID-0, I mean, the authorities also don't want the opposite. They don't want a widespread public health disaster heading into that Congress either. So that's worth thinking about.
And given the fact that housing is such a huge proportion of the Chinese economy, how much is this Congress willing to support the housing market, considering that it has been crashing, there has been issues with the development sector, but it also wants to reduce some of the leverage that's been put into the economy in large part through the housing sector?
Well, indeed. So they've gone quietly on the three red lines. Last year, when the economy was going well, the authorities thought they had a moment to come in and try and clean up the leverage and the excess risk taken in the financial sector. Homes were meant to be for living in, not for speculating. That was the mantra. But of course, this year, with the economy going the way it is, they're easing up on that crackdown, easing up on the regulation. We are now where we are with the mortgage boycott in 90-odd plus cities and over 300 projects. We are seeing the authorities move now. There's some talk we reported and others have reported of a state-backed loan that might be coming to inject money into those troubled real estate developers and companies. And of course, there are other measures being taken to allow mortgage holders a kind of a window of forgiveness until their property actually gets built. It's an unusual feature of China's property market that there is a very high proportion of pre-sale and the mortgages start from the beginning. So the authorities are moving on what's happening on the real estate sector. They're not as focused on leverage. And to your point, they will want to try and put a floor under that before the Congress.
Just real quick here, Enda, do you think the people are overestimating or underestimating how much demand has slowed down in China for some of the basic commodities, especially since that's been one of the factors that's taken some of the heat out of some of these gains that we've seen in prices?
It took to call these because there are different views. There are those who say China is now turning a corner with the economy, and obviously that will start to build demand for the imports that they need. There are others saying, look, things are still pretty bad on the ground, and the authorities haven't yet come to the races with a kind of a massive stimulus. So I think it's hard to gauge, but what I would say is the hole in demand in China's economy right now feels very real.
Enda, thank you. Enda Karen there of Bloomberg. Enda, always great to catch up with you late into the evening in Hong Kong. Lisa, if you're going to deliver 3% GDP growth in a country like China, that's going to come with problems. We're talking about some of those problems.
And they're massive, and they're on the heels of the zero COVID policy. How much have we baked that into some of the slowdown that we've seen in the demand for gas, and I think of oil, gas meaning oil prices and then gasoline, but also with respect to iron ore and some of these commodities that have absolutely surged? How much do we see a reversal of that as the demand softens on an ongoing basis in China?
Many people have that three handle for this year, Tom. I just went on ECFC for China this year, 4%, 4.0%. Is the median estimate so far.
Yeah, the rule of thumb has always been 6%, maybe a little bit under that 5.8%. It's simple, John. They got to fix COVID. That's where every discussion starts and ends. It's just
How do they
as
fix
simple
it,
as
Tom?
that.
What with? They don't want the mRNA vaccines,
based on
do
the
they?
medical pros we've talked to, they've got to, find a way to save face and get mRNA vaccines in there big time.
The other news this morning, we'll stay on top of this for you. When do you hear of this? Top of the line iPhone 13 Pro. On sale in China for 4 days, $89 off. You don't associate that with Apple often. From New York City, this is Bloomberg.
What the Federal Reserve wants to see is that there's a trend down in inflation.
They understand that there's nothing that could damage their credibility more than sustained inflation.
Policymakers in the Western world are going to need to do more, unfortunately, to bring inflation down.
We see this broad environment where economic growth is slowing.
Things are starting to slow down more materially than maybe what many in the markets are thinking.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene back together again. Thrilled you're with us on radio and television. An eventful week to a Fed meeting. And then after that Fed meeting, an important measurement, John, of GDP. Within the GDP report, a measure of inflation, we go from a negative 1.5% to 8%. The survey, 7.9%. That's trouble.
It's the path to September, Tom. That's what Wednesday is all about. We're looking for a 75 basis point hike. Will that be the last 75 basis point hike of this rate hiking cycle? Before you get to September 21st, that's the next Fed meeting after this one. You've got two CPI prints. You've got two labour market reports, Tom. On the latter point, will we start to see some weakness emerge there after 3 weeks of seeing jobless claims in America start to inch higher?
Well, you look for every tea leaf to come in here, and as we've said through the morning, we're all as data dependent as we've ever been, really worldwide as well. But, John, I just don't see how the story changes coming from 9-ish% inflation down to, let's say it comes down to 7% inflation. That's miles of work to be done.
Begs the question, Tom, how much damage needs to be done to GDP in between then? This could be a second consecutive negative GDP print in America. You'll get a ton of pushback about whether that's a real recession or not, Tom, based on what's happening with the labour market. But to your point, if we settle down at 5-6%, then the Fed's got more work to do, hasn't it? And what we've heard from the likes of Citi is that more work to do means a 4 handle on Fed funds, not 2, not 3.
JP Morgan gets to a positive statistic, Lisa Abramowitz. They do so through a one-off on exports, including maybe a nascent recovery in China. We're still pandemic adjusted, aren't we?
We're pandemic adjusted when it comes also to the inflation that we're looking at, because a lot of this does have to do with supply chain disruptions. About a third, if you take a look at some studies that were presented to the ECB in the past few weeks. How much does this color the Fed's view versus not, versus a Fed that is not looking for nuance? It is looking for inflation that is too high, and they are still worried about the Volcker-esque picture of having to deal with inflation that doesn't come down. And then if they don't get it down far enough and they ease off, what happens if they lose all credibility?
Lisa, I know you've caught up after Nepal and Kathmandu. Can you tell me what you see in the credit markets? We missed auction chat. What's happened to the dynamics of credit?
It was tough climbing up to the hills of Mount Everest. Honestly, we've been looking at a rally that's been dramatic. I leave and everything pops higher. And that seems to be the theme. Last week was an incredible rally in credit. This is poised to be the best month for riskier credit in the United States going back to March, April, May of 2020, when the Fed was really stepping in with some of their survival programs. How much are we looking at a dead cat bounce, as we were hearing about earlier, versus something that's more sustainable, given the profile of these companies that have financing for years out to come?
John, we're deep into July. I mean, we're picking on Lori Calvasina today just because she seems to be the one, but it's absolutely amazing how strategists not are micro adjusting, but just trying to keep up with the guesstimates in the news flow.
At 4,200, the new price target at RBC. Lorry came down from 4,700. Tom, this is a big week for earnings this week. Those 5 big tech companies make up 20% of the S&P. They make up 40% of the NASDAQ 100. That's where you get a really clean read on what's happening with ad spend. That's when you get a clean read of what's happening with the consumer, Apple, what's happening with FX, big multinationals, the translation from foreign currency back to the US dollar.
Right.
And Tom, ultimately, maybe some insight into what's been happening in China as well. And we know that's not been great.
Well, the China question is really open. I'm with Jay Pulaski on that, but we'll have to wait and see. John, to me, the data point of the last 72 hours of trading, and this goes back to the for your Emmy consideration, folks, what John did on the Real Yield Friday was breathtaking. The real yield really came in last week from a 0.6
How do you say that with a straight face?
Into 0.47%. The 10-year real yield is a positive number, but I'm sorry, it made some headway back to the zero level.
We're starting to see the intended consequences of Fed policy, Tom, as you start to get that positive real rate. They wanted to see a slowdown in housing. We're seeing evidence of that. They wanted to see job openings come down as evidence of demand maybe just softening a little bit. What they don't want to see, Tom, is that happen all at once, really, really fast and in a way that they can't control. Will we be confronted with a wall of economic data much more sooner, quickly, than they're anticipating?
The Bloomberg Surveillance booking team, cool, calm, and collected here into a busy week for us. There's no time off. Let me tell you, folks, it's extraordinary. The interns have really saved our butt this week. And the bookings into Friday, I can't say enough. When's the Fed meeting, John? Wednesday?
Wednesday.
I can't say enough about the quality of the bookings for the Fed show. You're going to love it. Matthew Desock gets us started strong here. CIO Fixed Income Strategy at Merrill and Bank of America Private Bank as well. Matt, how close are we to this strange word I haven't used since time began? Restrictive? I get accommodative. It's part of our generational DNA. How close are we to restrictive?
Getting closer, anyway. Definitely getting closer. We'll see another 75 this month is our expectation on Wednesday. And then probably at the next meeting or two, by the end of this year, we'll be into restrictive territory. And Jonathan actually stole some of my thunder and hit the nail on the head earlier. The Fed's policy is working as expected. And while we're not actually seeing a decrease in inflation, Tom, as you pointed out, we're seeing all the leading economic indicators rolling over, jobless claims higher, consumer confidence down, yield curves gone from flattening to now inverting. All of it is telling you, it's really giving the market actual confidence that inflation will come down. And that's hard to believe because the market's been wrong-footed by inflation numbers and by Fed communication, to be fair, for over a year now. But you're definitely in the sense that the market senses a slowdown across consumer activity, particularly on the housing market. Again, all the data is coming in telling you that inflation, which is a lagging indicator, tells you what happened, not what's happening now, what's going to happen, should be decelerating quickly. Now, the Fed's going to have to see that to adjust policy, but they will be restrictive by the end of this year, in our opinion.
Matt, when do you think that weaker economic data becomes undesirably weak? What would that look like, and where would you look for it?
So we think we've got a while to go. We're still at 3.6% unemployment or so. Our forecast is from Bank of America Securities for a mild recession, that unemployment rate moving up to 4.6 or so over the next year. The Fed is going to be able to deal with negative economic data. So unemployment rate moving into the mid 4%, high 4%, even 5%, unless they actually see the whites of inflation's eyes, unless they actually see it decreasing, we think they're going to tolerate a fair amount of economic weakness, which is not our projection, but we do think they've got a fair amount of ability to handle significantly higher unemployment, because again, there is, as Tom put it, there is a long way to go from 9.1%.
And Matt, perhaps this
use the 1970s as a lesson. Sorry, go ahead, Lisa.
Well, no, I was just going to say that, and I'd love you for you to continue. But Matt, this is the reason why people are saying that perhaps we've seen the peak in the 10-year yield, because the weakness that we would have to see in the labor market, in the economy, to achieve what the Fed is looking for, is substantive and would lead to much lower growth going forward. Do you agree we've seen the peak and that we're only going lower on longer end yields?
So we had this conversation last time. We had the view, I forget last time we talked, either March or April or May. We thought the 10-year was going to consolidate in that low to mid 3% range. And the clues we looked at was the yield curve flattening from 160 basis points to flat. That was the 2s, 10s. And we saw future Fed rate in 2023. And that was sort of our framework for looking at that. That has not changed. We still believe we're in that consolidation range. And future Fed cuts have only increased. There's now about 4 Fed cuts priced in after they actually hit the peak of 3.5% or so next year. So it's absolutely the case. It's absolutely possible that we have seen the high in 10-year rates. We wouldn't say that for certainty. We never say anything with certainty because there is still a chance that the Fed is behind the curve on inflation. And if the 1970s is any example for us, coming into the 70s, core inflation was about 1.5%. And there was an inflation spike. They got to about 3.5%. Then there was another inflation spike, and it got over 4.5% as an average. When Volcker raised the Fed funds rate to 20% 3 times in 1980, he only got core inflation back to 4% for the rest of the 1980s. So it never got back to the 1.5% level it started at, or the 3.5% level. It stayed at 4% core inflation for the 80s. So that's just an example that getting inflation back to where you started can be quite difficult. So if that's the case, then the Fed might have to do more than the market currently expects. The market says about 3.5% as the peak on Fed funds at the end of this year. If the Fed has to readjust to get above 4%, you could certainly see another spike higher in 10-year yield.
And we get whipsawed by all of that all over again. Matt, thank you. Matt Dizok there of Merrill and Bank of America Private Bank. Lisa, that's one more name to the long list of names I've got now who are basically calling potentially the higher the 10-year yield for the cycle for the year last month.
And a lot of that has to do with the idea that the Fed is going to get what it wants, which is much slower growth. They're going to tolerate pain, and then they're going to be able to start cutting rates as inflation does go lower. And the threat to that really is the Volcker-esque type of 1980s inflation that so many people don't think is what we're facing right now.
So what are financial conditions doing easing over the last month?
Thank you, John. Thank you. I looked at it 3 times this weekend. Way under a standard deviation grim. It's a better statistic in my optimism.
Bloomberg's Gary Gurumurthy pointing out what's happening with triple C's, Lisa, the junkiest of junk.
Oh, yeah. Rallying. People just piling in.
The first monthly gain this year, the biggest in 20 months.
Here we go.
Unreal. Futures up 0.5% this morning. Good morning to you all from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Treasury Secretary Janet Yellen says she does not see any sign that the U.S. economy is in a broad recession. Yellen has told NBC that the U.S. is likely to see some slowing of job creation, but said that is not a recession. She also expressed confidence in the Federal Reserve's fight against inflation. Now, the European Central Bank may not be done with big increases in interest rates after last week's half-point hike. Governing Council member Martin Kazaks has told Bloomberg that the rate increase in September also needs to be quite significant. The ECB is trying to reduce inflation that is already more than 4 times its 2% target. Right here in the UK, Liz Truss says if she's the next Prime Minister, she would introduce low-tax investment zones to spur economic growth. The Foreign Secretary is leading the polls to succeed Boris Johnson. Her rival in the race, Rishi Sunak, has pledged to crack down on China's influence here in the UK. He calls it the biggest long-term threat to Britain. A Bloomberg exclusive today, the investment bank founded by billionaire Ken Moelis is starting a group to focus on global blockchain deals. Moelis and company is beginning its effort in the midst of a so-called crypto winter. Venture funding in the industry has tumbled. Meanwhile, the price of Bitcoin has plunged to less than 1/3 of its record high of more than $68,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Everyone's looking for another rate hike this Wednesday.
Central bankers basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
The right thing to do at this point in time is actually position yourself for a little bit of patience in your portfolios and have those higher cash levels and perhaps take advantage of the higher relative rates that we're seeing in the front end of global interest rates.
Jerome Schneider there of PIMCO. Good to catch up with him on Friday going into the weekend. Coming into this week, looking ahead to the Fed decision and a ton of tech earnings. Futures going into that positive by 0.5% on the S&P, a lift on the NASDAQ up 0.4%, a lift in Treasury yields as well. Curve steeper up 6 basis points on a 10-year, 281.23. Jim Bianco of Bianco Research with the quote of the month so far. Easily. This year's inflation has peaked as last year's inflation is transitory, Tom. Jim making that point to us last week.
Well, that's the dynamic of price, and of course it's something that's affecting all of our listeners and viewers as well, and that's why this conversation is critical. Stephen Englander is esteemed in foreign exchange analysis. He is flat out the best cross-rate strategist in the world. He joins us now with Standard Charter. Steve, your view is an outlier. We go to 3.0%, and then we stay there for something like 5 or even 6 quarters. If we get a Stephen Englander outcome way below the gloom that's out there, what does that do to the certitude, the belief in a resilient and strong dollar?
It's going to damage it. I think that the market is waiting to see clear signs of a recession. I mean, the signs are powerful, but not definitive yet. And they're waiting to see some sign that inflation is coming off. We think all of that will begin to occur in Q4. And, we think the Fed will call it quits at that point, at least sort of say, look, we're going to wait and see where inflation goes until, before we keep on hiking.
What size of big figure move does that mean for the dollar? I mean, are you looking for 5 or 10 big figures of euro strength off of your 3.0% and stay there U.S. call?
Mostly, but mostly in 2023. I think 2022, there's still some, risks that, that the, profits stay weak or look weak and that the equities come off. We're still not sure what's going to happen in China or what's going to happen in Europe over the winter. So we think it's, the risk on trade is going to be harder than the market thinks over the last week. But 2023, I think, will be a weak dollar year, and 5 to 10% is perfectly reasonable.
So 5 to 10% isn't necessarily 10 to 20%, obviously, but this is a big differential when it comes to how much some of risk assets can rally on the heels of that. What will be the driver here? Is it euro strength or is it dollar weakness more broadly in the face of more optimistic sentiment in risk assets?
I'd say it's the second. I think the key thing is to get some evidence that inflation is coming down, and notwithstanding some of the pessimism. What we've seen is that wages are lagging, so there's no sort of red-hot labor market pushing up inflation. Real wages are falling like a rock. We're likely to see some of the, demand destruction leading to price falls in energy prices. We're already seeing that, even in things like cars and some other goods. I don't know that this inflation is going to be permanent, but I think the outlook over the next year is actually pretty good. And I think that once the market sees that, it's a risk-on market, both hands.
Steve, it's incredibly lonely. I mean, everybody's out at 3.5%. And John, help me here. We're out at 4% at Citigroup. You mean some of
on
the
Fed funds year end, yeah.
These are huge differentials, folks. I really can't say enough about it. What do you say to people that are convinced they're just going to keep going and going and going? What will be the damage to their portfolios, Steve?
Well, look, I think a very famous economist once said, everybody's got a plan till they get punched in the face. And right now, we haven't seen the downside on the economy. The labor market numbers look okay. There's no big unemployment. We think that pickup is coming. And when it comes, the pressures on the Fed are going to be different. And the Fed itself, it's not even, sort of responding to a shift in the political climate. It's the idea that if the unemployment rate is going up, it means that demand is below supply. And every model they have tells them that means inflation comes down. It could come down a little bit quicker, it could come down a little bit slower, but it means that they've sort of got themselves on the track that they want to be. Having gotten on that track, why keep pushing it? Since the big uncertainty, if you're at the central bank, is not what the neutral rate of interest is, because they don't have a clue and nobody's got a clue. The big uncertainty is how fast the economy is responding to the tightening of monetary conditions and how fast inflation is going to respond to that. And only time will give us that answer, because we don't have any good models for that.
Stephen, given the last point that you made, that we don't have any good models for this, can you give us a sense, in your history, strategizing about markets, how uncertain this scenario is, how much of a lack of a conviction you have over a dollar call at a time when the dollar has really been one of the most difficult calls to get right?
Well, it certainly has been difficult to get right, but right now everybody's got dollars. And, the market's very long. I can't think of a currency that's long versus the USD at this stage. And I think that what you're seeing is not evidence that the US economy is better in some ways than everybody else. What you're seeing is indications that the world is such a scary place that the only currency asset you want to hold is dollars. I think once those fears recede, the dollar is very vulnerable. And again, it's a 2023 story. At one point, we had thought this might be a 2022 story before the Russian invasion. It wasn't the case. But I think you have to see continued, a terrible world continuing for dollar strength, to keep going in the way it has been.
Steve, awesome to get your view on things.
Stunning.
As things evolve over at the team at Standard Chartered. Steve Englander there of Standard Chartered. Over the weekend, Eric Robertson putting out this note, Tom, the title, Fools Rush In. Fools Rush In, from Standard Chartered and the team over the weekend.
It's absolutely fabulous. And folks, this is what surveillance is all about. Just hugely divergent opinions. To have Ed Yardeni come up here is even better, John. But to have Englander with a 3.0-ish and the others, not others, but some strategists out with a 100 basis point differential out to 4% or even higher. This is fascinating.
It comes back to the same thing, Tom. How quickly does inflation come down? That's it, isn't it? Isn't that the dividing line between the two groups?
That is the mechanism. That's the process to watch, yes. But wrapped around it is how quickly does the economy slow and a Fed, a central bank, adjust.
It's certainly, Tom, that divides the equity strategist without a doubt. This Thursday, we get GDP. Lisa went through the numbers. Bank of America, TD, Deutsche Bank, Nomura, all looking for a second consecutive quarter of negative growth.
And we get Pinterest
in America. And Pinterest Friday.
It's Friday, yeah.
Lisa just so fired up about Pinterest this Friday. Won't stop talking about it in the commercial breaks. Tom, she thinks it's a bellwether for ad spend.
Yeah, I want to redo my sync.
Futures positive 0.4 on the S&P, on the Nasdaq up by 0.4%. Big week ahead for tech earnings coming right up. Big week for the Federal Reserve as well this Wednesday. 75 basis point hike expected. What will it mean for September? Yields now up 7 basis points, higher by 7 basis points on a 10-year to 282. Euro showing some strength. Dollar just a little bit of weakness. Tom, euro dollar 102.34.
Right now. This is perfect, John, and thank you to our great booking team for doing this as we've talked to Andrew Hollenhorst and others. And moments ago, a stunning conversation with Stephen Englander of Standard Chartered. We find someone to talk to with some perspective. Edward Yardeni is president of Yardeni Research. That barely describes his years of work from C.J. Lawrence and on, and we're thrilled he could give us a moment of time here in a most uncertain summer. The great gap, Dr. Yardeni, is Stephen Englander saying the Fed will stop at 3.0% and others out at 4%, or dare I say even 4.5%. What a divide. Explain the debate of that divide and where you fit into it.
Well, I guess I'm in the range of 3% to 3.25%. So I agree with the economists that
Stephen Englander, yeah.
Yeah, well, to Stephen, for sure. And the reason for that is I think what has to be factored in is that quantitative tightening, which means the reduction of the Fed's balance sheet, has a tightening impact. It's equivalent to some rate hike. The Fed hasn't really produced any estimate of that, but I would say it's at least 50 basis points from quantitative tightening. And then there's a strong dollar, a 10% increase in the dollar since the beginning of the year. I think that's at least 50 basis points. So there's a tremendous amount of tightening already going on from these two developments. And so I'm not convinced that we're going to have to see 4% or higher.
Are these rate increases nonlinear? We had an original one of 7.5%, and now we're going to 75 basis points, excuse me, and now we're going to have another one. This one's got a lot more wallop to the system, doesn't it?
It does, but the financial markets, I think, have discounted it. The financial markets are not going to be surprised by 75 basis points at this one or the next one, quite honestly. I think it's pretty well anticipated. I think the other thing that's very important to look at is we're constantly focusing on the Fed funds rate. We really have to look also at the longer end of the marketplace, particularly the mortgage rate. I think that's where the tightening really has been extraordinary. We've seen this basically doubling of the spread between the mortgage rate and the 10-year bond yield. And that's kind of put the brakes on anything housing related. We're seeing that not just in housing activity, we're also seeing that in housing related retail sales. So I think that's where the Fed has already accomplished what they wanted to accomplish, which is to put a lid or at least break some of the demand that's contributed to inflation.
Yeah, the only problem is, Ed, that a lot of this is supply side driven and it's not trickling in just yet, at least not in the numbers, to lower inflation. We haven't necessarily seen peak inflation because we haven't necessarily seen a drop off in any material way. How much does this factor into your belief in a soft landing or challenge it if the Fed is hiking, tightening, and you're not seeing a response in inflation?
Well, you nailed it. I mean, that's really the issue is if inflation just remains persistent, protracted, then obviously the folks who are saying the Fed's going to have to kind of do a Volcker 2.0 are going to be correct. I think there's already some signs. I'm obviously reaching for whatever I can find, but I'm looking at the regional business surveys, and both New York and Philadelphia surveys for July, so they're very current, are showing that prices paid and prices received indexes are in fact starting to moderate, as are their indexes for supply chain disruptions like backlog of orders and so on.
Okay, but Ed, there also are other surveys that show that a lot of companies do expect supply chain disruptions to continue for the years to come, and that's accounted for about a third of the inflation so far. Basically, all of this, trying to put it together, you came on the show a couple of months ago and you said you still believe in a soft landing, you still believe in the strength of the U.S. economy. Have you shifted at all?
Not really. I think that clearly we're going to have a negative real GDP number in the second quarter this week, so we'll have two negative quarters in a row. But as you know, that's really not an official recession. I think it's a mild recession at best. I think it's a mid-cycle slowdown, kind of consistent with what we had in the mid-1980s and mid-1990s and mid-2010. So we've seen this before. The consumers in good shape. The corporations are in good shape. So no, I don't see a hard landing.
Ed Yardeni, how is the equity market linked to this, and particularly where you and Steve Englander are of 3.25%, dare I say 3.5%?
Well, it's never easy to pick a bottom in stock markets, but I'm going to give it a try. I think that on June 16th, when we fell down to 3,666 on a closing basis, which, by the way, was 3,000 points higher than the intraday low that we had in 2009, making a bottom. I think that was the bottom. And coincident with that is we have seen commodity prices coming down. We have seen a slowing in the economy, which I think will help to moderate inflation. And the real question is going to be the earnings season. And so far, the earnings season is going reasonably well. It hasn't really trashed the stock market. The stock market's held up quite well.
I've got that at 10:22 a.m. on June 16th, just for some people to single point where Ed Yardeni is on a bottom to the market. Ed Yardeni, we talk here about what a chairman will do with the Fed. What will you look for in the press conference? He's got to come out and frame what he does after a presumed 75 beeps. How does he do that?
Well, I think he's going to find his inner Volcker. I think he's going to come out very tough on inflation. I think we're going to find that the word inflation appears numerous times. And I think he'll make it very clear that this is the Fed's priority now. It's quite a shift from what we saw before, following the initial pandemic effect in August of 2020. The Fed changed the priorities and made it clear that bringing the unemployment rate down was the number one priority. Now they're doing it again. Powell is the great pivoter, and he's pivoting again towards the notion of the Fed has to do whatever it takes to bring inflation down.
I love it, Ed. The great pivoter, and he's finding his inner Volcker. Fantastic ways to color the moment that we're in. How much do you view the 60-40 as still being viable if we've seen the bottom, as you're saying, in the S&P, but also are looking at someone who is finding their inner Volcker heading the Fed?
Well, when you say 60-40, you're talking about a bond equity portfolio?
Yes.
Yeah. Look, I think in line with this scenario of mine, I think 3% is the right rate for the bond market. I don't know that you're going to make a lot of money with a drop in bond yields, but 3% is back to normal. And that's a pretty good return. That's one of the reasons that we've seen valuation multiples come down so hard in the stock market, but they have come down, and they're kind of fair value as long as we don't have a hard recession. If we have a hard recession, then you want to be 60 in bonds and maybe 40 in equities.
And I've got to squeeze this in. Can the bond vigilantes in Europe make a comeback? Or will TPI stop that from happening?
Well, yeah, I think the ECB is going to give the best try here to avoid fragmentation and support Italy, for example. So I think they have come back, and it's a big challenge to the ECB.
Ed, your world of bond vigilantes. Ed Yardeni there of Yardeni Research, taking it back a long time when Ed came up with that one, Tom. How many years ago was that?
It was a long time ago when there wasn't a bear market like this.
Sure.
Again, and Ed lived it. I mean, 78, 79 pre-Volcker was really something, and that was a walk in the park compared to where we are right now.
In many ways, the week begins tomorrow, not today, when we get earnings from Microsoft and Alphabet. Facebook Wednesday, Amazon and Apple on Thursday. Lisa went through all the economic data we get through this week as well, Tom. Then you've got the Fed sandwiched somewhere in between on Wednesday.
We're trying to make Monday eventful as well. And, you know, I think there was some really, I think without question, the conversation this morning was Stephen Englander. I mean, how many people disagree in the game with Steve Englander? And the answer is 7 out of 10, maybe 6 out of 10.
I think we're pretty divided, Tom, down the middle at the moment, to be honest with you. We go back to that 9 handle on CPI.
Yeah.
Many people saw that and said that was the peak, Lisa. Others looked at it and said, well, I see evidence of this being stickier, staying with us for longer.
This is the toughest market I can imagine. There's so many different facets. And factoring into the supply side constraints, it's many different areas of the supply side market. The idea that it's not just China and supply chain disruptions there, it's shipping lines, it's people getting sick, it's very human, and it's very disparate. How do you connect all of these dots and get an economic picture? And that's why I think earnings actually will be the most interesting, followed by that employment cost index. How much do we see that rolling over as an indication of something that perhaps is a deflating in this inflation bubble?
Do you think Chairman Powell lays out the road towards September?
No.
Or avoids it completely?
Avoids it completely.
John,
is that the goal on Wednesday?
I think so.
Yeah, John, I just looked at August 10, the ECO screen. We don't have a year-over-year CPI, core, et cetera, study yet. But it's amazing how the month-over-month first look really comes down.
And then September 13th, the one after that, Tom, and
yeah.
Jackson Hole somewhere in between.
Comes down.
You're looking for a pause or something, Tom?
No, I'm just
looking for a road trip.
Looking for a road trip.
For
Jackson
our
Hole's
viewers,
confirmed. We're going to that too.
Exactly.
For our viewers and listeners, John, what's the difference between 7% inflation and 9%? I would suggest nothing.
What's the difference for this Fed? I would suggest they've got to keep on going, whether it's 7, 8, or 9. Coming up, I'll catch up with Michael Kushma of Morgan Stanley Investment Management. We'll talk to Anne Miletti of Allspring and Peter Chi of Academy coming up at the 9 o'clock hour as well. Why he thinks we could get that recession sooner and why it could be deeper and more uglier than people expect. Peter Chi of Academy. Join us at 9:30. Bramo will make some notes and double down on them.
Of course.
And then come back tomorrow and
She's
tell
doing
you all
a
about
slideshow.
it.
She's got the carousel projector.
Lisa, I missed you. It's great to have you back.
It's great to be back. I've
Alongside
missed you
Tom
both.
Keene, I'm Jonathan Ferro, ahead of a big week here stateside. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve will probably have to inflict much more pain on the economy to get inflation under control after raising rates in June by the most since 1994. Policymakers are expected this week to approve another 75 basis point hike, and they are likely to signal their intention to keep moving higher in those months ahead. Now, the U.S. said that a Russian cruise missile strike on the port of Odessa has cast doubts on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed after months of talks. Russia says a missile attack targeted Ukrainian military infrastructure. Tesla has increased its capital expenditure plan to as much as $8 billion a year. That is according to its latest quarterly report. The report also disclosed details about another subpoena from security regulators relating to Elon Musk's tweet about taking Tesla private. The company has said it is cooperating. And it's a big win for Intel and for Washington's goal of increasing semiconductor production at home. Intel has secured one of the biggest customers yet for its year-old contract chip-making unit. It will make chips for the Taiwanese company MediaTek, whose chips are used in Amazon's Echo speakers and Peloton's exercise bikes. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
This is not an economy that's in recession, but inflation is way too high. And, the Fed is charged with putting in place policies that will bring inflation down. And I expect them to be successful.
The Secretary of Treasury of the United States, Janet Yellen, there, speaking the message on NBC this Sunday. Right now, Lisa Abramowitz and I are thrilled to give you a different view. It's been a really intellectually interesting Monday here at Surveillance. We've had some optimism out there. We've had a lot of measured views of a measured recession. Nouriel Roubini flat out doesn't agree. He's Chief Executive Officer of Roubini Macro Associates and joins us now here and will continue on radio into our next hour as well. I have talked about Willem Bouter's rigor this weekend and looking at TPI, which, to cut to the chase, he thinks is complete folly as well. What was it like when you walked in his office at Yale University decades and decades ago?
Well, he was the one who hired me at Yale, so he has been a great intellectual friend, always rigorous, very opinionated and so on, and mostly right.
You too, and mostly right. You too, the gentleman from Netherlands and the gentleman from Istanbul in Italy, you too have an old world view. What is the old world view of this recession, this slowdown that we're in, where maybe it's a mega threat, as your new book is called, this new world, it's all going to be fine, is off the mark?
Well, now the consensus view is becoming that hard landing is likely as opposed to a soft landing. But now people say, well, be short, shallow, mild, plain vanilla, garden variety. I beg to disagree. I think there are many reasons why we're going to have a severe recession and a severe debt and financial crisis. Debt ratios are at historically high, 420% of GDP in advanced economies and rising. Lots of zombie corporation, household, government, financial institutions were bailed out during COVID. This time around, we're tightening monetary policy. During the 70s, we had stagflation, but debt ratios were low. After the GFC, we had a debt crisis, but inflation was falling, deflation, because it was a demand shock and you had a credit crunch. This time we have stagflationary negative aggregate supply shocks,
Right.
and debt ratios that are historically high. And in previous recession, like the last two, with massive monetary and fiscal easing. This time around, we're going to go in recession by tightening monetary policy with no fiscal space. So the idea this is going to be short and shallow.
Okay.
It's totally delusional.
Out of their COVID disaster, can China come to the rescue? If we see resurgent Asian growth, does that help us?
Well, if China were to grow faster than otherwise, that would help everything else equal. But until November, until she is reelected, they're going to keep their zero-tolerance COVID policy. And their overall policies are essentially against economic growth. Yes, political objectives are redistributing wealth and income. Yes, had a backlash against the private sector, against the tech sector, and so on. And I don't think that the Chinese policy is going to change. They're bound to have low economic growth. They have high debt ratios. They'd be lucky if the next few years have 4% growth, most likely lower than that. They're
Nouriel,
not going to be a source of growth for the global economy.
a lot of people look at the lack of leverage, at least financial market leverage, akin to what we saw leading up to the 2008 crash, and they say that alone will allow this recovery to be quicker and allow the downturn to be more shallow. Where do you see nodes of leverage that could be unwound or be unwieldy that could actually cause what you're looking for?
Well, first of all, there is leverage in the corporate sector. Debt ratios are very high for some subset of the corporate sector. It's true that banks now are not as leveraged because after the global financial crisis, they deleveraged, but there's been a rise significantly of the debt and the leverage of the non-bank shadow financial system, leverage loans, CLOs, and you name it. And those spreads are already widening, and there could be a shutdown of them, of those markets, if you have a severe recession. So I would say corporate first, then shadow banks. Many sovereigns are in trouble. And there is half of the household sector that has low income, is fragile, has a lot of debt, not much wealth, and in recession, risk of unemployment. So even the household sector is divided.
In the past, the financial sector has led the economic sector. You've seen the financial meltdown, and in some people would say caused, right? And I'm thinking about the 2007, 2008 bust, and then the 2009 recession. Is this time different? Are we going to see the economic downturn before the markets wake up to the reality that you're talking about and start to respond in suit?
Yes, the economic downturn this time around is going to lead to severe debt distress. I would say you're going to see parts of the corporate sector going bust. You'll see the parts of the shadow banking system going bust. You'll see the household sector that is partly fragile going in trouble. You'll see some sovereign going in trouble. Yeah, the trigger for the financial distress is going to be a recession, and recession is not mild, shallow, but it's going to be severe and protracted. And there'll be then a vicious cycle between the real side and the financial side of the economy.
In this stagflation, do you believe what so many guests on this show have said today, that we have seen the peak in 10-year yields for this cycle?
No, I expect that inflation is going to remain persistently high. There are actually medium-term forces going to lead to stagflation over time. Protectionism and deglobalization, reshoring of manufacturing from low cost to high cost, aging of populations, restriction to migration, decoupling between US and China, global climate change, cyber warfare, new pandemics, backlash against inequality, weaponization of the dollar. People are not thinking about the medium term. In the medium term, I see in my book about at least a dozen different types of stagflation and medium-term shocks. Going to keep growth low and cost of production high.
We're going to continue this on radio, but I got to ask one question for our television audience and for those worldwide that really, really listen to Nouriel Roubini. Have you ever been this gloomy before, or is it a different gloomy?
Well, it's a different gloomy. I was gloomy right before the global financial crisis.
You and I sat in Davos. Come on, we sat in Davos over a beverage, and you absolutely nailed that. That's why people are listening now.
Well, I think in some sense right now is worse because in the 70s, as I pointed out, we had stagflation, but debt ratio were low. So there was not a debt crisis. There was one in Latin America. And after the GFC, we had the debt crisis, but we had lowflation and deflation. I think that this time around, you're going to have the confluence of stagflation and of a severe debt crisis. You'll have a stagflationary debt crisis.
Yeah.
So it could be worse than the 70s and post-GFC.
We're going to continue on radio with Dr. Roubini, and I want to make clear he will not be a stranger. And, of course, an important book coming out. It's a kind of book where if you're an optimist and you flat out disagree with Nouriel Roubini, you still got to read the book to frame out your thoughts to push against mega threats. We'll see that, I believe, in October. Lisa, what's great is Nouriel just sold the movie rights. It's great.
Well, he laid out a pretty gloomy scenario. He almost makes me sound rosy. At the same time, there is a lot of legitimate argumentation in all of those points that are important to consider, whatever your view, simply because we are seeing a sea change with respect to supply chain disruptions, with respect to the deglobalization or regional globalization, or however you want to call it. There are some big changes happening, and how do you factor these out into a new environment for price increases as well as monetary policy?
And what's so important about this, and I put Roubini and Bowder together, and also with the great Stephen Roach as well, is one of the rare Americans, and it's interesting. They're all out of a Yale complex over the years. But they're very balance sheet centric versus income statement solutions. It'll be interesting to see how that plays out. This was a really informative Monday. I thought it was going to be a snooze fest. Wrong on that. Some really interesting stuff to think about. Diving into the week, and of course the week is to Wednesday, and an important meeting, the Federal Reserve. We'll do our special coverage in the afternoon as well. Stay with us. This is Bloomberg.